It's 9 a.m. live from the Nasdaq market site in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance Live, and here's your morning rundown. A tale of two tech giants, Microsoft, and we also have Google. Now, Microsoft's cloud division was the shining star, with revenue up 19%. Investors were excited by the company's investment in AI, which helped drive sales and overall growth. And though Alphabet delivered a better than expected bottom line, a miss in its cloud division cast a big shadow over the company's quarter.
Fourth time's the charm? Question mark. House Republicans select Congressman Mike Johnson for their latest speaker nominee. Here's the fourth name put forward since the ouster of Kevin McCarthy. Johnson said he'd call for an official vote later today. Though it's not clear if he has the votes to win on the House floor.
And rough landing. Boeing cut its 737 delivery forecast as it works through production issues surrounding its most popular aircraft. Now, the issues also widened losses for the quarter, though the company managed to top revenue expectations. Boeing also stuck to its free cash flow goal for the year and plans to keep its 737 production ramp-up plan unchanged.
Well, let's get to today's morning driver and go to the cloud. For that, it was very much a tale of two tech giants. We've been tracking Microsoft and Alphabet reporting Tuesday, and the big differentiator, the cloud. Microsoft's push into the AI space, boosting its overall performance. Azure grew 29%. That was up from 26% in the previous quarter. And the other side, Google's cloud missed expectations, even though it reported growth of 22% on the year. The report spooking investors that it isn't keeping pace with Azure or Amazon's AWS. Here, take a look at both of those shares. Year to date, yeah, good stuff happening, taking place on kind of a broad stroke there. But here's what we've seen said about this. Wedbush's Dan Ives called it a flex the muscles moment from Microsoft. Tech investor Richard Windsor saying Microsoft is really getting under Google's skin here. Now, there's a few things to really break down, and of course there's going to be anything that's said around AI, but we'll get to that in a hot second. Let's stay in the cloud though, because for Google, I mean, this is still largely an advertising-based business, and search really pushing much of that, but then also some of the subsidiaries, YouTube, of course. YouTube non-advertising revenues, they said, were driven by subscriber growth within YouTube TV, followed by YouTube Premium Music here. So perhaps one of our own producers who has the tendency to just go play YouTube music videos is actually helping out YouTube or Google here with some of these results here. But this Google Cloud segment, I think, noteworthy here. Revenues were $8.4 billion for the quarter. That was up 22% here, but it really comes back to where organizations are continuing to spend into some of their cloud endeavors. And we've talked at length, ad nauseum in some cases, about the multi-cloud strategy by some companies and how they're employing that. But at the same time, for these companies, they're just going to hope that any type of cloud strategy incorporates the collaborative suites and tools that either Alphabet and Google here or Microsoft for the other end have for a lot of corporations that have been able to lean into them for decades at this point.
Yeah, certainly. And that really is the focal point of these reports, and really just what we're seeing, the difference between Google, the growth that they're seeing within their cloud business, and comparing that to what we saw from Microsoft. Because when you take a look at these Azure numbers, very impressive. We're seeing that reaction on the street here this morning ahead of the open. Azure accelerating for the first time really that we've seen for the fiscal third quarter of 2022 in just about 2 years here. Reading this from the Jefferies note here. Azure grew 28% on a year-over-year basis. That's up from 27% in the fiscal fourth quarter, and also was 2 points above the high end of the guide here. So very impressive numbers, enough in terms of what the street was looking for. We know a lot of that growth being driven by demand for its new AI products. Exactly what that means here for Microsoft's future sales here, and how much of a drive that's going to be going forward. When you take a look at the Azure Cloud Services, comparing it to the growth that we saw in the previous quarter, we saw growth of just about 26%. Revenue overall up 13% on a year-over-year basis, the most in 6 quarters, also topping analyst projections. So very impressive here from Microsoft. On the other hand, Google, the street certainly wants to see a bit more.
Absolutely. We also had a mention of ChatGPT on the Microsoft earnings call, of course, as we're thinking about AI and continuing this conversation. That's going to be a major focal point as well, how these companies are invigorating that strategy, investing into it, and where it's going to play a role in perhaps our everyday lives as part of search, too.
Let's get to someone who certainly knows what he's talking about when it comes to AI and cloud and where these two companies stand, what we learned from these prints last night. Yahoo Finance's Dan Halley joins us now. Dan, your first take.
Yeah, Sean, it was really a kind of a tale of two clouds, basically a tale of two companies. These results show that Microsoft is truly ahead of Google when it comes to its AI deployment, when it comes to the customers that it's signing up. Sundar Pichai basically started out the Google call talking about AI, but then, discussing other aspects and mentioned the cloud, but only briefly. Whereas if you listened to Satya Nadella on Microsoft, he just rattled off, statistic after statistic after statistic about how AI is being rolled into the cloud, how they're doing more and more with it, how they're offering more capabilities, how they have open source options from Hugging Face and Meta, and how they have so many subscribers already signed up for this. And so that's where I think investors saw the look at Azure and the growth that Azure had, the 29%. They were expecting 27% growth. That's a reacceleration of growth, by the way. The category had seen a slowing of growth over time, and people were taking pause over that. But this reacceleration really kind of getting people excited, I think. And then, the idea that AI is playing such a big role here. And Nadella pointing that out multiple times during the call. With Google, it was more along the lines of, we have AI, we're doing well with AI, but it's not quite impacting the cloud aspect as much as we would like to see yet. So, I think that's where investors are a little concerned, or perhaps taking stock of what's going on with Google and Alphabet as far as the cloud operations go, and can they keep up with Microsoft and AI, which is a wild statement to make, considering that the very reason why these, ChatGPT, the T stands for transformer, the reason why these transformers exist is because of Google research, and Microsoft kind of taking the lead with that OpenAI work.
Dan, when we think about how AI is being positioned, or the narrative that these companies are telling around it, it's how AI is going to essentially be a co-pilot. What more do we get on details about what the pricing for a co-pilot, or how the contribution to margins that a co-pilot may also offer to these two major companies, what that might look like for investors who are looking for any type of clarity on these investments as well as the payoff?
Microsoft had said that their Microsoft 365 is going to be $30. Copilot is going to be $30 per seat per person. And so that's something that's really interesting, because it's on the higher end of what people were expecting. As far as margins, there's going to be some problems, I assume, with the kind of outlay that they're going to have to make as they continue to build out these different capabilities, these different offerings. They're going to have to buy more hardware to run servers. They're going to have to continue to invest there. And that's on both sides, right? That's with Google and Microsoft. And Microsoft's apparently working on its own chip, and Google working with its own chip. So, it could be a hit to margins over time, but I wouldn't assume it to be too bad.
All right, Dan, thanks so much for breaking that down. We want to dig a little bit deeper into these reports, because investors are cheering on Microsoft after the tech giant saw reacceleration in its Azure cloud business after 2 years and capitalized on a cutback in operating expenses, showing a 27% surge in net income. Now, Microsoft CFO Amy Hood telling investors, quote, "Looking on a competitive basis, we feel good about our execution, we feel good about taking share, and we feel good about consistent trends." Let's bring in Rishi Jaluria, RBC Capital Markets software equity analyst, joining us now for more. Rishi, it's good to see you. So Amy Hood feels good about these results. What do you think these results tell us just about where Microsoft is positioned amongst its rivals?
Yeah, and really great to be here. Look, I think the numbers absolutely speak for themselves. And we can talk a little bit about the AI strategy. But what I think this is really telling us is Microsoft is in a league of its own when it comes to enterprise software, when it comes to tech. And part of that, I think, just goes back to the pace of innovation and the rate at which they've been able to integrate and infuse AI throughout their entire product suite, I think is surprising all of us. And that's starting to show up in the numbers, where we're seeing this faster than expected ramp and adoption of AI revenue. And really, ultimately, I think that goes back to a big bet that Microsoft made on AI, and very specifically on OpenAI going back to 2019. So I do think this bodes well for the rest of tech earnings season and software earnings season. But again, I do think Microsoft is very much in a league of their own.
And so with that in mind, is it clear, relative to the other competition that's spending or has yet to disclose how much they're spending on these AI investments, where Microsoft, even as they're leading the pack, where they can start to perhaps taper the amount of spending that they're doing on those investments and now kind of wait for that return to start to set in?
Yeah, I think that's what's really impressive is, Microsoft is investing very aggressively for Gen AI. I don't think anyone will look at Microsoft and say, they're being stingy with their investments or they're not innovating fast enough. What I think is great is Microsoft is offsetting a lot of that investment in CapEx with operational discipline in other areas of the business. By the way, I also wouldn't be surprised if to some extent they're already leveraging generative AI internally, right? Thinking about using things like GitHub Copilot within their R&D staff, and using AI within sales and marketing to be more efficient. And that's starting to help them. And you think about layering in all this AI stuff as well as Activision, and they're still talking about flat operating margins. I think that shows that they're pairing this with discipline.
Rishi, when you take a look at these results, what this means for Microsoft in the bigger picture, right? Because lots of questions just about the software business, whether or not we have seen a full turnaround within that industry. What do you think these results tell us about where maybe the broader industry stands?
I think it's showing us relative stabilization. We're not quite on that path to, core cloud reaccelerating. And, I think if we think about the Azure line, we almost have to bifurcate it into two buckets, which is Azure, XAI, and then AI. So it still could take a few quarters before we see a reacceleration in Azure XAI growth. But AI is doing a lot of the heavy lifting for Microsoft right now. So I think what this shows us is there are pockets and signs of relative stabilization, which is a welcome sign in, I think, this choppy macro environment.
Rishi, you mentioned the fact that AI doing a lot of the heavy lifting right now. How much do you see it adding to the top and bottom lines here over the next maybe 3 to 5 years?
Yeah, I mean, recall Amy had talked about AI becoming the fastest business for Microsoft to reach $10 billion in revenue. And when we look at our model and think about all the different areas AI is adding to, that number seems really achievable, if not actually conservative, if we're taking a 5-year approach, because there's a lot, I think, of new TAM that gets opened up when you start to layer in AI. So it is going to be massively additive. I mean, Office Copilot on its own, we think can be a multi-billion-dollar opportunity just by reaching a 2 to 3% attach rate of Office 365 commercial users. Like that gives you a sense for the kind of scale that they can get to. In terms of what this does to the bottom line, I think that's a trickier question. As we know right now, generative AI is prohibitively expensive, and a lot of these Gen AI products are being priced to be competitive with cloud services and not necessarily priced for, I think, the value that they're delivering. That will change over time. But as it stands right now, it is going to be a drag on gross margins. It is going to be a drag on operating margins. I believe, by my estimates, GitHub Copilot is actually losing money on a per customer basis. I wouldn't be surprised if we see the same out of Office, but over time, this should all be accretive to EPS, which is ultimately what matters for the stock price.
Rishi, my final question to you is simple. How would you describe the year that Microsoft is having? $10 billion investment in OpenAI and really kind of thrusting them into the pillar of a AI conversation that's taking place alongside NVIDIA, of course, too. And then additionally, finally, the closure of this Activision Blizzard deal. How would you describe the year that Microsoft is having and what investors should be watching for next?
Honestly, it's an unparalleled year for Microsoft. Who would have thought if we were having this conversation a year ago, and I were to tell you, hey, Microsoft is the leader in big tech AI, not Google, you probably would have laughed at me and told me to get off your show. But here we sit today where Microsoft is in that position, right? And it goes back to this very strategic investment they made in OpenAI going back 4 years, but also having the kind of forward path to integrating AI throughout the suite, having this federated AI approach. It is honestly an unparalleled year for Microsoft. And I think it really speaks to what Satya Nadella has brought to Microsoft in terms of innovation in their DNA, which none of us could have seen coming when he first took over the position.
Rishi Jaluria, who is the RBC Capital Markets software equity analyst. Rishi, great to begin the day with you here, and appreciate the analysis coming off of these results.
Thank you.
Thanks. Well, stocks have been struggling to shake off the downbeat mood, increasingly hanging over asset classes. The risk of a government shutdown, the ongoing UAW strike negotiations, and rising energy costs have left investors feeling more pessimistic about what's in store for the economy. The bright spot could be earnings season, but it's been something of a mixed bag so far, though the last couple of days offering some room for optimism, cautious optimism as it may be. Our next guest says heightened risks are causing sharp divergences in financial markets. So now what? Joining us now, we've got Rick Reeder, BlackRock Global Fixed Income Chief Investment Officer. Rick, how would you describe where this earnings season perhaps can give us a little bit more clarity around broader financial markets?
It's a great question. So first thing I would say is there's dispersion. I mean, you look across, even last night, like you saw, I mean, the numbers that came across in terms of cloud performance, in terms of broader technology performance, I know there's real dispersion. I mean, we're getting a series of conflicting signs around market studies. It's why markets are so jumpy, so uncertain, why the depth. Like when you go to transact in rates markets, risk markets, the depth of markets is really shallow. So listen, I think the one thing you take away from it when you read some of these earnings, particularly some of the consumer data that we're getting, economy is moderating very slowly. There's still some pockets of significant strength, but the economy is moderating, and but it's still in a pretty good place. I mean, one of the things central banks have to work with is the economy still in pretty good shape. Although, if you said to me, what's the first derivative of change? It's to a bit slower, and I think the earnings are representing that.
Rick, when it comes to what's going on with equities right now and comparing that to what's going on within the bond market, obviously yields, the massive run-up that we've seen have certainly been a driver here of the recent action in equities. When we take a look at whether or not there's this debate right now, whether or not the sell-off has been overdone in bonds, where do you stand on that?
So in my career, I've never seen a greater divergence in technical conditions between bonds and stocks. And so first of all, stock market, there is, I think the number is 800 billion in authorized stock buyback this year. The IPO calendar, I think year to date is 19 billion. So put that in perspective, 800 billion just stock buyback away from what individuals do, and only 19 billion of IPOs. The technicals in the equity market are unbelievably good. Then you take the bond market where we're getting 400 billion a week of Treasury bills, and like this week, 150 billion of coupons. So this week alone, we're going to get somewhere between 550 and 600 billion of supply in a week. So the technicals are incredibly disparate. Listen, I think rates, could rates move a bit higher than where they are today? They could, certainly given the fact that we're getting so much supply. Listen, I think you have to balance that with we're now getting a shifting Fed very slowly, but is more tolerant of how much they've raised rates, and is more willing to look at the data, look at the lagged effects of monetary policy. So my sense is net. Listen, I think long end interest rates could move a bit higher than where they are today, but I think and I think where you're starting to see people about money, shorter term interest rates, even out to the belly of the curve, we call it around the 5-year point, the carry and the income you get is amazing. And that's why you're starting to see people shift and be more tolerant, even though the Fed, their next move would probably be hike versus ease. The carry and the income you get in fixed income today, without taking a lot of long-term interest rate risk, is pretty attractive.
Rick, the recent data points that we have gotten, though, have been a bit conflicting when you take a look at the fact that inflation has been rising, although just modestly here. Do you think that downward inflation trend, is that still intact? Is it enough for the Fed, do you think, to stay on hold at this point? Or should it be enough?
So it's a great question. So if you take the 6-month moving average of inflation, you get really comfortable that you were running core CPI. I believe it's around 3.5. That number, we've come down from what were very high single digits. You look at things like core goods, the 6-month moving average is pretty much close to zero. That number was up at like 12-13% for core goods. The problem is service level inflation is sticky high. You look at things like insurance prices, and which factor into the CPI report, they're still sticky high. And there are other parts of services that are still hard to bring down. So what does that mean? Listen, inflation is coming closer to target. We think core PCE, that's the number that the Fed focuses on. We think by the end of the year, it's about 3.3%. Next year, beginning of the year, it's closer to the high 2s, 2.7, 2.8. So the trend is right. The Fed's target is 2. We're not there yet. But I think because we've moved so much and the momentum is in the right direction and the economy is moderating, it'll allow the Fed to relax, and let's watch the data and hope this trend will continue to manifest itself. Our sense is, not without some bumps in the road, that we're moving closer to an inflation level that's higher than historically, but still tolerable for the Fed and other central banks.
What do you believe that the prevailing tone from the Fed will be in 2024, considering the data that's come through, considering how they're waiting for much of the policy that's been enacted thus far to still be ingested and to ultimately try and make sure that there still is the achievement of a soft landing, no recession scenario?
So, my sense is the first half of the year, the Fed is a watcher and is viewing the data and hoping that the trends continue around. By the way, I'm not sure there's even a soft landing. I'm not sure there's even a landing. I know we think GDP next year is going to be, real GDP is 1.5 or so, not bad. So I'm not sure whatever a soft landing is, I just think we're just moderating to a reasonable growth paradigm. And so I think the Fed's going to watch. But then as you get in the second half of the year, Chair Powell said on the press conference that if real rates, he's focused on real rates, if inflation is at this level, so think about, we talk about core PCE, let's say it's 2.75-ish. We can't have the funds rate sit at, particularly if the economy is moderating, employment is not at the accelerated pace. You can't have a funds rate that's 5.5, 5 5/8, because the real rate, less the rate of inflation, is too high. So meaning the Fed's got to start cutting rates in the second half of the year. And I think that's what they'll do. But I think in the, for the first quarter, maybe in the second quarter, I think it's a lot of watching the data and hoping that that things work out the way they should.
Rick Reeder, we got to leave it there. We always really appreciate your insight. Look forward to having you back soon. BlackRock, a global fixed income chief investment strategist. Thanks so much. Louisiana Representative Mike Johnson was nominated to take on House Speaker late Tuesday night. He's the fourth Republican nominated this month for the Speaker's chair, following Representative Tom Emmer, who withdrew from the running after facing opposition from the GOP's right flank. Let's bring in Yahoo Finance's Rick Newman. Rick, another day, we've got another name that we're talking about. What's going on here?
A lot of people are wondering, who is Mike Johnson? I guess he's some guy they found sitting on the Capitol steps. They said, hey, you want to be Speaker? So they're going to give him a shot. He is a very conservative member of Congress. I think he's in his fourth, could be his fifth term. Low profile guy, but what's worth knowing about him, first of all, he is an election denier. He did vote against certifying Biden after Biden won in 2020. So he's got that going for him. That means Donald Trump likes him. Donald Trump has actually endorsed him, or at least said, yeah, this guy's good with me. So he's not going to get opposition from MAGA world, which is what doomed Tom Emmer. And if anything, this is obviously just farcical. This is going on and it's into its third week. If anything, maybe the end game is coming into view here. So some of the political analysis I'm following says maybe Mike Johnson can get it because he has just not pissed off very many people among the Republicans. And that has been the problem with some of the prior guys. They have enemies, and the enemies have come out and stabbed them in the back or sometimes just stabbed them right in the front. So he doesn't have as many enemies. So maybe he'll get it. And if he doesn't get it, this might be the last gasp before they go to this sort of alternative outcome, which is just make Patrick McHenry, the guy in the bow tie, make him the Speaker pro tem on an official basis. And then they can work with Democrats to get some things done. So I know everybody's just tuning this out and glazing over. This might be sort of a procedural moment when we are getting closer to some sort of outcome here.
All right, Rick, this is really, unprecedented
ridiculous.
Even as you were mentioning. And
it's it's a farce.
Right. And so is there any light at the end of the tunnel that is that much more clear, even now that you've got Representative Mike Johnson here that's going to be voted on?
Maybe. And the test is going to be, we got deadlines coming up. It's not like there's nothing on the agenda and this can just go on indefinitely. The big one is obviously that the federal government is going to run out of funding in just a few weeks. Those temporary spending measures from the end of September expire on November 17th. So that's coming right into view. We've also got this big bill that President Biden has asked for, security funding for Ukraine, Israel, Taiwan, southern border. The Senate is working on that. The Senate doesn't move fast, but if the House cannot get its act together and originate a bill on that, which it can't without a speaker, the Senate will send the House some legislation eventually, and that will force the House to do something. So we do have some forcing functions coming up here. But if anybody thinks that even the election of a Republican speaker will sort of settle the matter and the Republicans will settle down, I don't think so. I mean, I think we just have, this is made very clear. There's a civil war in the Republican Party, MAGA world and Donald Trump on one side, moderates on the other, and they are just going at it. And I think this is going to continue all the way through the 2024 election into 2025, and we'll see what happens, who gets control of the House after the elections next year.
Rick, thanks for keeping tabs on all of this. Appreciate it. All your markets and much more coverage of what's going on inside the Beltway ahead, everyone. Live from the Nasdaq market site, you're watching Yahoo Finance Live.
T-Mobile following in its rivals' footsteps, raising its free cash flow guidance for the year after adding a net 850,000 postpaid mobile phone customers in the third quarter. Verizon sang a similar tune in its report yesterday, sending the stock to its highest level in nearly 15 years. T-Mobile's tie-up with Sprint in 2020 shook up the wireless market, leaving itself, Verizon, and AT&T dominating the space. When you take a look, Brad, at this report here, you have T-Mobile's third quarter service revenue exceeding the street's expectations. A lot of this being attributed to the growth that they've seen in 5G, the strong brand recognition that they're building around that. And like we just said, this comes amid pretty stiff competition, obviously, from Verizon, from AT&T. It's a tough environment out there. The postpaid net additions obviously helping the street's sentiment towards the coming year. But postpaid broadband additions is also important to point on here because it's a new growth area for T-Mobile, and they beat the street's expectations with just over 500,000 net adds for the latest quarter.
Yeah, they're saying that 300 million Americans are now using this ultra capacity 5G, which, I mean, for many of us who were wondering for many years how 5G would improve latency, how many of us would be able to see a noticeable difference. It seems that there are a large amount of people now that are kind of seeing that and recognizing that as the standard. I think, though, for across all of these networks, how they are for T-Mobile, for Verizon, for AT&T, how they're investing in their different bands. And for myself, I know I need to go back and do another deep dive on each of them and how they've kind of decided which bands they want to play in. But that's also played into the pricing strategy that they're able to move forward. You mentioned some of the phone customer, the net additions there of 850,000. The high-speed internet customer net additions, 557,000. They're saying that that was the best in industry here. If you're taking a look at shares of TMUS over the course of this year too, it's been an interesting one. Year to date, it's only up by about 2.6%. So not the best, not the most standout year for connectivity service for many of us who see this as a necessity purchase. So there's a larger question too here for some of the connectivity payments that need to be made on a regular basis by consumers too. If there are delinquencies that are starting to show up in some of that system too. And that's something that we've been tracking, especially as consumers are making sure that if there is pressure in their household balance sheet, that they're kind of offloading that, or at least, unfortunately, in some of those cases, having to put off payments where necessary. But over the past year, 52 weeks, here's a look for you. It's only up by about 0.5% here. So we'll continue to watch this, but stay tuned for our executive editor, Brian Sozzi's interview with T-Mobile CEO Mike Sievert. That's at 10:15 a.m. Eastern Time today. You won't want to miss it. There he is in the magenta sweater, right?
I like it. Right on brand. Yeah. Man, can't miss them. All right, well, guys, we got to get to the opening bell here because lots of action. We were just talking about some of those individual movers. T-Mobile was one of them. But let's take a look at the broader action that we're seeing play out across the street. We still have the Dow holding on to gains, but it's a different story for the S&P and the Nasdaq, both moving lower here at the open of the trading day. We got some mixed reports after the bell yesterday from Alphabet, obviously disappointing the street's expectations. That stock under pressure this morning. Microsoft on the flip side, muting some of those losses that we're seeing more broadly in that sector. Again, the S&P moving to the downside here, off just about 0.5%. Well, speaking of some of those big movers today, we also got to talk about Boeing because it is getting a bit of a boost this morning despite slashing full-year expectations for its 737 MAX deliveries. It's now forecasting between 375 to 400 from the previous 400 to 450. You're looking at gains of just about 2%. Now the company posted a wider than expected loss, but saw revenue jump 13% from a year ago. Yahoo Finance's Pras Subramanian joins us now with the details. And Pras, it looks like it was good enough for investors, at least right now.
Yeah, shares up despite some bad news here. The company reporting that top line missed, he mentioned, of $18.1 billion and a wider than expected loss of $3.26 a share adjusted. Though the company reaffirmed its cash flow projections for the year, which seems to be boosting shares, but it's that delivery forecast for that 737 MAX, its workhorse jet, that is again a headline. Boeing saying that a supplier issue was identified on the aft pressure bulkhead section of the plane. Not a safety issue at the moment, it said, but it will impact production. And as you mentioned, Boeing now seeing 375 to 400 jets delivered this year, compared to 400 to 450, which was its earlier projection. Now, one more bit of news on the positive side for Boeing is the 787 Dreamliner wide-body jet. Boeing now transitioning to 5 deliveries per month from 4 in terms of production, and is on track to deliver 70 to 80 jets of those 787 jets this year.
And Pras, when we think about what this means for Boeing going forward and how they're going to kind of make up for a lot of those deliveries, is there any kind of clarity that they provided around that, and when ultimately investors can expect that to be reflected in some of the financials too?
So CEO Dave Calhoun said that despite some near-term challenges, they remain on track to hit their financial goals and goals for the long term. Apparently, in a memo to employees, he says that we're going to root out these production issues and it'll be the end of it. So he is sort of claiming that this will be the end of these long-term issues with the 737 MAX. As you know, a few years ago, they had the main issue with that, which was the safety problem with that one sensor, and that caused a massive headache for the company. They're sort of slowly getting back from that. Once they have fixed that issue, now they have no number of other issues from suppliers. So they're sort of rooting those things out. Calhoun is confident that he can do it. And with the sort of updated projection here of 375, 400 jets a year. It seems that they're maybe finally getting to that point, and maybe they're going to potentially increase that production going ahead, where they want to hit something like 50 planes per month by 2025, 2026. So I think it's that couple years sort of term that we'll probably see Boeing back to normal, if you can call it that.
All right, Pras, thanks so much for tracking this one, helping us break this down, wrap our minds around some of the numbers that just dropped for Boeing. We'll keep a close eye on the ticker symbol BA as we move on throughout the rest of the day. Yahoo Finance's own Pras Subramanian. Well, markets opened just a few minutes ago, and Jared Blickery is standing by with more. Today, he's at the New York Stock Exchange, live in living color, bells and whistles and all. Hey, Jared.
Hey there, I thought you guys could use a change of venue, so here I am, and my goodness, what a great crowd. We had Vestas at the opening bell. They were nice enough to bring their own noisemakers, still ringing from that. Looks like the Dow is in green territory here, but the Nasdaq taking on the chin, down about 1.23%. I'm just gonna show, this is a year-to-date chart. Let me put a line on there so you can really see it. This is just a flag, so not anything to be concerned about. S&P 500, as long as 4,200 holds, nothing to be concerned about there. But one of the things I have been tracking is the Korean markets, very much leading edge in terms of tech. They can be considered a bellwether. And I want to show you the composite index over the last 5 days in Korea, down 4.7%. That's this lower line right here. Nasdaq down 2.5%. So as long as that trend continues, not expecting a great rebound in tech. And a lot of what we've been talking about depends on what's happening in the bond market. Today, bond yields, we take a look at the 10-year, that's up a few basis points, not back up to 5%, but that is going in the wrong direction for stocks. That big, quick advance in the 10-year T-note yield has been really weighing on some of the mega caps. Now here, interestingly, we can take a look at the sector action. Communication services is down 3%. That is an outlier. No coincidence, that's what houses Alphabet. Let's go over to the Nasdaq 100 where we can see Alphabet down about 8.8%. And let's take a look at the year-to-date. They were, as far as the mega caps goes, they were probably the closest to their 52-week highs. Now they're simply testing the bottom end of this trading range. When you take a look at Microsoft, now they are marching back towards their record highs. We'll have to see what comes of that. This action here just looking like a bull flag. And for the rest of the mega caps, it's largely red action. Apple down 1%, Amazon almost 3%, Meta right there behind it. And let's take a look at our leaderboard. We have crypto, second day in a row, that is in the forefront, holding about 35,000 in Bitcoin. Don't think we're gonna have time to see that, but we'll be talking about that in the show. The worst sector here that I'm looking at is solar, TAN ETF down almost 3%. China not doing very well, and neither is cannabis, so interesting price action there. I'm going to be doing a deeper dive into the energy sector in the 10 a.m. hour. Just want to show you real quickly, we got energy in the green today, and we'll also check out the banking stocks that we have here. Kind of a mixed board. Deutsche Bank up 6%. That's an interesting development there. That stock still underwater year to date. And also want to check in on some of the travel stocks. We're getting, we've gotten those earnings in fits and starts. Some of the airlines like Delta report early in the season, but this is a sea of red here. Not dark red, but red nonetheless. So most of these issues down less than 2%. Finally, let's hone in here. I want to check out meme stocks. Haven't checked out them in a little while, and in the fringier part of the market where you might see a little bit of risk allocation, we're not seeing that today. So a little bit of risk on. I think that we're seeing that in certain sectors, but balanced by some risk off in others.
All right, Jared, thanks so much for breaking that down for us. We want to get to a little bit more about what we're seeing play out in the tech sector, and that is investors taking a look at Snap here following its latest earnings report. Now, the company saw revenue rise 5% from last year. They also added an additional 9 million daily active users in the third quarter, bringing the total to 406 million. You're now looking at gains of just about 3%. Digging in to this report and some of the numbers that we got here from Snap after the bell yesterday, that daily active user number that I just mentioned, that was up 12% compared to a year ago. We talk about the fact that there's growing competition within this space. Yes, that is a step in the right direction, but it really is dwarfed by some of its rivals within the space. When you talk about TikTok, the rising popularity there and what that means for Snap and how often it is used, especially amongst the younger generations. But taking a look at the analyst reaction to this report, and maybe that explains why we're not seeing a bigger reaction in shares, at least at the open here. And was pretty much, the analysts seem a bit mixed on this report. They noted the recovery, Piper Sandler calling it fragile, so they're not fully sold on the direction of Snap going forward. And I gotta say, they make some good points because we've been talking about what Snap needs to do to turn around its business. Yes, they do have the subscriber option there, the premium option, but it's not doing too much for the business yet.
Look, I've had so many questions about the narrative, the trajectory, how Snap is going to eventually try and continue to make an effort to steal market share. Look, there's so many questions here. First and foremost, it is not a camera company. It is a social media company. And I think for how they continue to try and lean into that camera narrative, sure. I mean, everything that is on the app is kind of, it comes directly from what people are doing with their cameras on their phones. But at the end of the day, too, there needs to be more than that. There needs to be the community around what they're doing with AR, and that's pretty cool, too. They talked about that. They talked about AR Lens. You know, just coming back to the stock here for a hot second, though. The stock is up by about 12% year to date. That sounds okay. It's not. Because here's why. It's underperforming the rest of the major tech companies that are out there. You also think about the fact that for Snapchat and the investments that they've made in glasses and trying to make glasses happen. And now you've got Facebook that's eventually and probably going to leapfrog Snap and whatever they were trying to do with hardware. Hardware is difficult to put forward, especially when you don't have the cash positioning like some of the larger tech giants. And so that is difficult. For the brand of Ghostface Chilla, there's been a lot that they could have been able to lean onto, and they have been able to make the platform more shoppable. That is good, especially when you have a younger cohort of those users and trying to create more customer lifetime value, but that takes time. And you have to rely on them continuing to come back to that same platform for years and perhaps even decades. So there's that consideration. And then at the end of the day, too, you have to also think about the fact that for Snapchat and how the management team, I think, is going to make sure that not just on the product side that they're able to continue to bring back people, but where those marketers are seeing the opportunity to continue to layer in these advertising campaigns, because that's the bread and butter. That is where you're going to see the lion's share of those dollars come in, not just how much they're able to take, perhaps on a take rate of each sale that's made on the platform by a power seller or whatever, but at the same time, I mean, it's just been a company that at this point is trading, what, around $10, $11 here? $9.98. Company went public, I believe, at what, $17 when they went public. So
Not doing well.
Not good here. Ultimately here, let's talk about another company who you may have in your palm or your pocket or whatever. Texas Instruments shares. I'm talking about the TI 84 Plus calculator, all of those out there who played Block Dude at some point or another, or Centipede. Either way, the shares they're sinking this morning. They're down by about 3.3% after the chip maker saw revenue fall 14% from last year. Gave weaker guidance for the current quarter than expected. It grapples with headwinds in the semiconductor space. Not what you want to hear from Texas Instruments right now here today.
It's not what you want to hear. It certainly reflects maybe the sluggish tone that we've heard from others within the space, also forecasting what we could hear from many of its peers over the next several weeks when we talk about the rest of the earnings season. But digging in a little bit to this forecast that we got for the fourth quarter, the company now seeing revenue of $3.93 billion to $4.27 billion, far short of what this rate was looking for, just around $4.5 billion, $4.49 billion. They also see EPS of $1.35 to $1.57, far below the street's expectations of $1.76. And when you take a look at its most recent quarterly results, third quarter results here, EPS of $1.85, down from $2.47 a year ago. Their revenue declining 14% on a year-over-year basis. And I thought Citi summed it up well in its reaction to these earnings reports. The company has a neutral rating on the stocks, and that their belief here that sales margins and EPS are going to remain under pressure due to that weaker demand, also lower utilization and higher depreciation. So we talk about the fact that the headwinds against this company don't seem to be over yet. You could see the steady decline that we've seen in the stock since towards the end of the summer, right around the end of July, beginning of August. And you're looking at a one-year loss of just about 12%, but that steady decline that we've seen over the last several months really points to weakness, not only in Texas Instruments, but what we're also seeing more broadly within the industry.
You know, Texas Instruments is also a company that does have some exposure to the UAW strike that's happening right now, too.
Yeah.
Some of those semiconductors go into vehicles and you think about some of the most basic functions of automobiles, whether they be electrified or whether they be standard and internal combustion engines, Texas Instruments still does have some of those core contracts. So any lack of production or lack of purchasing orders that comes through to Texas Instruments because production is sidelined or at least halted for the near-term period of time while negotiations move forward, that's a little bit of exposure that investors also consider. And it seems like some of them may have been doing so even with that slippage that we'd seen in the tail end of that chart you were pointing out a moment ago.
Yeah, it's important to point out here. Again, losses here for Texas Instruments shortly after the open. Well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Oil and gas producer Hess beating the street's expectations here for the third quarter thanks to a boost in higher oil production. Now, Hess making headlines earlier this week after Chevron agreeing to buy the utility company in a $53 billion all-stock deal just weeks after ExxonMobil announced it was buying Pioneer Natural Resources. Our next guest doesn't expect any more mega deals, but there could still be more consolidation within the industry. We want to bring in Tamar Essner, Victus Energy Partners Principal. Tamar, it's great to see you here. So let's unpack what we're seeing play out within the space, because the deal that we got from Chevron earlier this week obviously followed what we heard from Exxon, and this move, this doubling down on fossil fuels amid this transition, more broadly speaking, to clean energy. Why do you think these oil giants are deciding to go this route, and could it potentially backfire?
Thanks for having me. Just to clarify from your opening remarks, I actually do think that Exxon and Chevron will continue to make purchases, and there will be more mega purchases, just not in the near term. I think that those two companies are the most natural acquirers, and they've just made these two recent big acquisitions, as you noted, and it will take some time for them to digest. In the meantime, I think that there'll be more mergers of equals as the sector has to consolidate to achieve size and scale. To compete in a world where there is questions about the long-term terminal value of oil. And after there is more consolidation, I think ultimately Exxon and Chevron will then continue to acquire those bigger companies. So I just wanted to clarify that. I think that these deals make sense, though, whether you agree as being a bull on oil prices in the long term or as a bear. I think that there's a lot of rationale for these types of consolidations.
Tamar, what is that? And apologies for mischaracterizing what your expectations are. But when we talk about the rationale here, why this makes sense, why do you still think it makes sense then at this point?
Well, a couple of reasons. First of all, a lot of the best acreage in the U.S. Has already been acquired and been drilled. So I think that these companies are going to need to consolidate to deal with having more contiguous acreage that is in the best plays. And then at the same time, by reducing overhead, basically eliminating CEOs, eliminating headquarters, you're able to take down your production costs. And therefore, you're able to compete in an environment where oil prices are more volatile. And I think the last point is that it's really notable that these two acquisitions, both of Pioneer and of Hess, are buying assets that are mainly in the U.S. or in the Western Hemisphere more generally. And I think that what we've seen from recent global events is that energy companies have had to pull out of operations in Russia. There's obviously now big concern about operations in the Middle East. So I think that companies want to the extent that they're going to double down on oil assets, do so in environments that are stable and sort of closer to home and predictable operating environments.
Tamar, what do these acquisitions signal for any prospect of a clean energy transition to combat the adverse effects of fossil fuels?
I think that these deals are actually supportive of that because even in a transition to greener energies, we are still going to need oil and natural gas for some time. So this basically ensures that those assets will be developed in a way that's cleaner and with a lower production cost. At the same time, by combining companies, these companies are able to rapidly increase their shareholder buybacks and their dividends. So they're basically returning enough cash to shareholders that they are basically a free value, sort of like a freebie on the price on the terminal value of oil. Basically, they're saying we'll pay you back for all your investments. So if oil isn't here in the future, don't worry, you're already going to get more than paid back. At the same time, with that money that you've been paid back, you can invest that. The free market can invest that in green technologies, basically saying the free market can do that better than we can as a traditional fossil fuel company.
Tamar, when it comes to your outlook here for crude, the prices that we will likely see, we haven't really seen this massive move higher that many were bracing us for, as we saw following Hamas's attack on Israel. When we talk about the implications of potentially an escalating conflict, which you started to see here play out within the Middle East, what does that mean more specifically for crude in the short term?
Well, I think that the market's not good at understanding geopolitical risk, and it will fade that. The reason the market has been so complacent about the recent events in Israel with the war with Hamas is because there is so much spare capacity. Remember that Saudi has 1 million barrels a day just in unilateral cuts, in addition to all the OPEC production cuts. So basically, in a context where there's a lot of spare capacity and there's questions about the demand, the market has been fading the geopolitical risk and sort of trending lower, as you indicated. I think that the most near-term risk from a supply perspective is actually if the Biden team starts to more proactively sanction Iranian barrels. But I think that will be more bark than bite. It will actually be very difficult to implement those sanctions at this point because most of Iran's oil is going to China in non-dollarized trade. So I think that unless there is an actual hit to oil supplies, even if this conflict escalates, unless it's going to involve Iran directly, even if it escalates just in the form of Iran's proxies, whether Hezbollah, Hamas, the Houthis, and as we've already started to see that it's escalated from those proxies, there's not going to be much reaction in oil unless Iran is involved directly or unless we see direct targeting of oil assets.
We were watching, especially as many world leaders and business leaders descended upon Davos or not Davos, excuse me, Freudian slip there, Davos in the desert, where there is much conversation taking place there. And it's only right that they also note in some of those talks, too, that Saudi Arabia had announced cuts to its own production. Where do you believe that there's going to be, at least from that instance or that summit, more of the conversation around where some of the cuts that had been initiated by Saudi Arabia, by Russia, will perhaps be taken off the table, or do we expect those to just remain on long term in this near term as one of their own kind of pricing mechanisms or pressures that they can put on the larger global economy?
Yeah, so I think that Saudi Arabia is going to be very reluctant to add those barrels back unless prices really start overheating to the point where we see demand destruction. And I think that Saudi would need to see sustained prices over 100, maybe even $110 a barrel for some period of time before they start to do that. I think that Saudi Arabia is very worried about the impact of higher interest rates in most of the developed world and a slowdown in China. And so they are trying to front run a downfall in oil prices by keeping these production cuts in place very early. Like, they started them, earlier this year and sort of front run what they see as this slowdown. So I think that they'll be very unlikely to do that. At the same time, Russia actually has not been compliant with their production cuts that they just announced. They were offline a little bit for maintenance. Now, seaborne exports of Russian crude are actually starting to ramp up. So I think in an environment where there actually is a lot of supply in the market and demand is questionable, unless there's a really big conflagration, a spread in the war, Saudi is really going to be sort of reticent to add more barrels.
Tamar, really good to see you this morning. Thanks so much for joining us, adding a lot more context on this for our viewers here. I just noticed that the globe behind you is also spinning and rotating too. Okay, we got rid of a shot.
It's solar powered.
Tamar, it's solar powered? What?
Yes, and I'm sitting near a window.
They need to see the globe. They need to see the solar-powered globe that is behind her. Okay, amazing here. Tamar Essner, Vectus Energy Partners Principal. Great to see you, Tamar. Talk to you soon.
Thank you for having me.
All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. The 10-year Treasury yield has been on a run recently, jumping more than four full percentage points over the past 3 years before briefly passing 5% for the first time since 2007. Now, if that sounds crazy, it is. In fact, the last time yields went on a run like this, it didn't end well for the U.S. economy. Joining us now, we've got Yahoo Finance's Inez Ferre to help us break this down. Inez, how did it end last time? I think we all have some idea. And ultimately, do we expect it to be different this go round?
Yeah, you have to go back to the early 80s to see this rate of change when it comes to the Treasury yield. That was during the Paul Volcker era. He was the Fed chair that went in 1979 to beat inflation. And during that time, you saw the 10-year Treasury yield go up to as much as 16%. Now, keep in mind that it was a different era because the jet to GDP was much lower than it is today. But it's really the rate of change that worries so much investors. And also, by the way, in the 80s, you had a double dip recession after the yields went up so high and the rates went up so high. But just to back up for a second, when we talk about the 10-year Treasury yield, and you had mentioned it's gone up more than 4 percentage points in the last 3 years, it surpassed 5% briefly earlier this week. When we talk about that 10-year Treasury yield, we're really also talking about the cost of borrowing, because that's where you have mortgage rates that then go higher. You have loans that go higher for businesses, for governments, for consumers. So that's the concern, is that as it goes high, so high, then the borrowing costs go higher as well. And there's two things to keep in mind here. One is that this year, so many forecasters had said that 2023 would be the year of the bond market. You had the 10-year Treasury that started at 3.9%, and that yield has only gone higher. So it certainly humbled some forecasters that were saying that this would be the year of the bonds. But the other thing is also fiscal spending and the deficit, because the government has to fund its programs, it has to fund its spending. And as the interest rates go higher as well, when the government's borrowing money, it also has to pay higher interest. So what happens? The US Treasury then issues Treasury bonds and Treasury notes, and then that creates more supply in the market. And this is a time, by the way, when we have seen over the past year that other central banks have sort of pulled back from buying U.S. Treasuries. Namely, there's been a lot of talk about China that's not bought as much as U.S. Treasuries, the Fed also as well. And what this does is this exacerbates the situation, because you just have more supply in the market. And by the way, as you see also the dollar going higher, some governments are even selling treasuries in order to gain more dollars and also to protect their currency. So there is sort of a cycle that goes through all of this, but we are seeing more treasuries enter the market. As far as how far can the 10-year Treasury yield go? I mean, at 5% or close to 5%, that's a good yield. So you'd think that investors, pension funds, governments would go in on this. There is a Bloomberg report, a Bloomberg economics report, that shows that what they're forecasting is that government spending plus government borrowing plus spending also on climate change is going on. They're saying that you could see the 10-year Treasury yield go to 6%, guys.
Wow, 6%. All right. And that's something that we're going to be continuing to watch here, this massive move that we've seen most recently in the bond market and what the implications are there. Nesfarai, thanks.
Thank you.
Well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. I'm Shauna Smith alongside Brad Smith at the Nasdaq market site in New York City. We're just about 35 minutes into the trading day, and let's take a look at how things are shaping up so far. And as you take a look at the major averages, we're seeing a bit of a mixed picture, some pressure here across the board as yields push higher once again. We also see earnings weighing on the markets here this morning. We got a couple of big earnings reports out from Google and from Microsoft earlier today. That was weighing on the broader markets. When you take a look at the S&P 500 right now on your screen, off just about 1%. Meanwhile, Boeing and Microsoft giving the Dow just a bit of a boost here. Investors on edge as more big tech companies do release their results. We also want to take a look at shares of Boeing this morning on the move. Now, they popped initially following this report. Now, third quarter miss on both the top and bottom lines, cutting their delivery forecast for its 737 MAX narrow body jet due to ongoing production issues. On the bright side, though, the company reiterated its expectations for 2023 free cash flow of $3 billion to $5 billion, despite manufacturing problems.
And IMAX surging this morning after reporting a strong year-over-year growth in its third quarter, with revenue up 51%, gross margins up 98%, and adjusted EBITDA up 174%. This was the company's second highest grossing quarter of all time, driven by successes at the box office from Oppenheimer, Mission Impossible 7, and Indiana Jones.
And Hilton shares are on the move today after they reported their earnings results that beat the street's expectations. Revenue jumped nearly 13% from last year, but the hotel chain gave a stark warning for the current quarter, expecting a, quote, meaningful uptick in earnings.
Yeah, this is a huge quarter here, critical for Hilton, and what we heard as we're watching shares up by about 0.8% here. One of the things that I continue to think about is where system-wide they're bringing on new rooms. And this is not just Hilton. This is across Hilton, this is across Marriott, and it's as they are competing with some of the larger kind of scaling up that even the HomeAways of the world, or well, the Verbos or the Airbnbs are trying to make sure that they're doing in tandem and bringing on more hosts. So you're looking at a competition of capacity right now. And speaking of that capacity, they have approved about 35,500 new rooms for development for the third quarter, and that was just during the third quarter. So their pipeline is sitting at over 450,000 rooms, 457,300 rooms in the pipeline as of the end of this quarter here. So that's growth of about 4%. And what that's trying to do on a pricing perspective, I mean, because all of us who have stayed in Airbnb or one of the property rentals, I get frustrated, and we've talked to Brian Chesky directly about this before, how much I am done cleaning. I can't do it anymore. Every time I stay in one of and they're great. They're great. The hosts are super nice in many occasions, and they're willing to take care of you. They're awesome. But at the end of the day, I think for a lot of the responsibilities that people are comparing in the stays for hotels versus the stays for some of the rental properties, if it's just that small thing that you can take out of there, and the fee that you're being charged on top of that, and fee transparency also a part of this. But I think that's where, for a lot of the hotels who are bringing on more capacity, the consideration has been, okay, how can we make sure, as we're bringing on more capacity, that we're also making sure that we have a competitive price landscape too, where the consumer feels like they're getting more value, and then the rewards, that's a whole different conversation. But I think that's where they're continuing to really layer in to this portfolio of hotels that they have.
Yeah, Brad, I think you summed it up well. When we talk about just the ongoing trends that we're starting to see within the travel sector, this pretty much reiterates what has been called out from a couple of the other executives so far this earnings season. Yes, we had this massive pent-up demand for the post-pandemic travel. That's starting to wane just a bit. When you take a look at domestic numbers here, not too impressive, but overseas, we're still seeing some outperformance here in terms of the international hotels, making up for some of the pullback that we're seeing domestically. The question, though, is how long that's going to last, especially since so many Americans are still feeling the pressure of inflation, what exactly that's going to do to results here going forward. One of the big focal points, one of the big concerns, more broadly speaking, on the street going forward.
Absolutely. All right, well, we just had the banner up for some new home sales. We'll take a look at those in just a hot second here as we are getting some fresh numbers that are coming in on that front.
Yeah, for new home sales, they rebounded just a bit here in September, up just about 12%. You see that full number there on your screen, 759,000 in the month of September. Taking a look at some of these numbers here, that was up from a revised 676,000 the prior month. This is according to the latest numbers that we're getting out from the Commerce Department. Now, we know that this number is seasonally adjusted, and it also just explains just the number of homes built out over an entire year, and if builders continue or are going to continue to build at that very same pace. So taking a look at these numbers that we're getting, U.S. new home sales rebounding just a bit last month in September, up 12.3%, Brad.
Yeah, 759,000 for a seasonally adjusted annual rate that we saw come through. And I think ultimately here for the 12.3% that we mentioned, that is above the revised August 2023 estimate of 676,000. So we got a revision there on that August number as well here. But ultimately, I think for where the sales are going forward, where they're taking place, it's still an environment where in the rates that people are being able to take on and ultimately having to figure out what the calculus is in order to not just purchase a new home, but then what that financing looks like long term, that pricing is going to come into play as well. The sales price, the median sales price of new houses sold during September, $418,800. The average sales price, though, that came in at $503,900.
We talk about the fact limited supply continuing to push up prices that people are paying across the country. Now, this rise in new home sales follows an 8.2% decline that we saw in August. Let's get to our market commentary of the day. And right now, we're taking a look at what investors are saying may have an opportunity to do something that probably didn't seem possible earlier this year. And that's buying the dip on NVIDIA. Shares of the AI juggernaut fell sharply earlier in the month following the U.S. government's announcement of new restrictions on exporting AI chips to China. Now, investment bank IBBA is advising clients to buy, saying in a recent note that the stock's decline has, quote, fully priced in the China restriction effects or is very close to doing so. The analysts have a $600 price target on the stock, pointing to a 40% upside on the share price. So they are acknowledging, yes, it is a headwind here for NVIDIA. In terms of the degree of that headwind, at least in terms of IBBA, they think a lot of that has already been priced into the stock. We heard from NVIDIA earlier this week saying that the accelerated licensing requirements they don't think are going to hit results. The licensing requirements were originally set to be effective after a 30-day period. They're now effective immediately. They don't see that materially changing the near-term meaningful impact on financial results. But of course, the question is what that longer-term impact looks like. And at least from this analyst perspective, they still think it's attractive at these levels.
Yeah, I mean, for NVIDIA, it's been one of the runaway stock stories of 2023. And one of the things that is next to consider for anyone who has already invested in or is thinking about, even at this point, buying the dip, as this analyst is pointing out the opportunity to do, you've got to think about what's going to come next. And of course, there was the most recent deal, or at least partnership, that was announced with ARM. But there's also the language models that still have yet to come to light here, where NVIDIA has already earlier this year talked about some of the large language models that they're going to leverage and bring to light here, whether that be in life sciences research and development, whether that be in how they're going to be able to kind of supercharge different discovery pipelines, either in that arena or in other areas. I think for exactly where NVIDIA moves forward from here, you think about the three pillars, basically, of this larger generative AI landscape. And it is the models that sit kind of right in the middle, but on top of those models, you've got the applications. But at that bottom end, and where NVIDIA has really been able to capitalize on the demand, is the chips. Getting the chips right so you could have the models that sit on top of them, so that you can have the applications that then run on those models as well here. And so that has been kind of the larger consideration, regardless of the stock fluctuations that we've seen most recently here too. Also, speaking of AI, the hype around artificial intelligence has dominated the business world for the past year. But implementing the revolutionary technology may be harder than it seems. According to EY's latest CEO Pulse survey, the AI buzz may be creating too much noise for executives to cut through. While 99% say that they are planning to invest in generative AI, 68% say uncertainty around the tech creates challenges for adoption. For more on this, we have EY Global Vice Chair of Strategy and Transactions, Andrea Garzonu. Great to have you here with us today. First and foremost, what are you hearing from CEOs who are trying to figure out how many Benjamins they got to earmark for investment in AI?
Hello, it's a pleasure being here. As you said, it's on top of every CEO's agenda. It's the buzzword now, but at the same time, when it comes down to adoption and understanding really the value that can be extracted from this technology, it becomes much more complicated. So our survey showed very clearly that almost 2/3 of the 1,200 CEOs we interviewed are struggling with the actual application, and they are keeping themselves in terms of talent, in terms of educating the management teams, hiring the right people, but at the same time, the application is not that easy.
Andre, what do the partnerships look like when they're talking about furthering their progress and adopting AI? What does that strategy look like? What are you hearing from business leaders in terms of how they're approaching that?
I think they are very cautious. I think the technology is evolving extremely fast, and I mean, there's a huge fear of making mistakes. The cost associated with this technology is very high. I mean, the development of proprietary language model to ensure safety in the use and effectiveness in the adoption, it's an element of complexity. So they are trying really very hard to understand which use cases can be adopted first to test the technology, to develop further use cases down the line. I think the first applications are really more related to efficiency, trying really to reduce costs, to trying really to understand better how this technology can evolve. And I think the next step will be definitely the impact that these technologies can have on the top line growth. And finally, really devising a strategy that would allow companies to redesign their business models, their processes.
What type of expectations do they have in terms of productivity from what you're hearing from some of these leaders?
I think that the use cases we have currently deployed show that there could be significant boost in productivity, talking about 20-30% when it comes down to education, white collar type of work, really giving these machines the possibility to ingest huge content, manuals, quality type of stuff that today is basically completely manually managed, that can be actually completely automated through this technology. And this allows really companies to redeploy the existing workforce in order to make them focus on a much more value-added kind of tasks.
Andre, when it comes to M&A activity, we've heard some comments from some business leaders this week just talking about the fact that it might take longer to rebound in 2024, given the geopolitical escalation, given the fact that we see inflation very sticky throughout the world. What are you hearing from business leaders about what their expectations are going to be like for deal-making activity next year?
I think that this view is pretty much confirmed by our interview. I mean, the interviews are showing that there's obviously a huge focus on investment, but in the next couple of quarters, it's going to be more organic, more through joint ventures and partners rather than pure M&A. I think the underlying reasons are pretty clear and evident as the high interest rates and the geopolitical uncertainty, and also the impact actually of these new technologies that would require for sure M&A type of activities to accelerate the adoption. But given the uncertainty we mentioned before, I think they want really to be sure that they are buying into the right technology, they're buying into the right companies. So all these elements compounded actually are going to provide probably still a rather subdued level of activity.
Andrea Garzoni, great to get your perspective here. Thanks so much for sharing the latest survey that you have on business leaders throughout the world. EY Global Vice Chair of Strategy and Transactions. We'll keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back.
Live from the Nasdaq market site in New York City, you're watching Yahoo Finance Live. AI has been the trending topic of the year, but it's also been the center of major debate, with Washington stepping in to prevent the new technology from spiraling out of control. Our next guest recently penned his thoughts in an op-ed detailing his worries about AI innovation, saying that it's being driven by big tech right now, potentially leaving very little wiggle room for disruptive challengers in the space, and perhaps too much regulation from Washington could undermine open source AI, ending the collaborative model that spurred innovation in the first place. Let's bring in Revolution Chairman and CEO, as well as author of Rise of the Rest, Steve Case, to discuss more. Steve, always a pleasure to have you on here with us, to get some of your insights. First and foremost, when you think about the innovation curve that we've seen with AI and how regulators, as you were bringing that into your op-ed as well, where they still need to wrap their minds around exactly what this technology means. How do you anticipate that for Washington, that's shown a lag in its own ability to understand the larger impacts or the revenue and profit models of some of these technologies, where they will start to take either preemptive action or whether they'll start to take any action at all?
Well, first of all, I think it is worth remembering that AI is not a particularly new technology. It's been around for a half a century. What's new is it's become much more popularized. The ChatGPT in particular kind of had an overnight success, almost a Netscape moment that we saw with the internet, where the internet was bubbling and suddenly things accelerated. And the good news, I was yesterday at the Senate as part of the AI forum that Leader Schumer and a number of other senators have put together in a bipartisan way. And we spent 3 hours talking about the issues, both the opportunities for AI as well as some of the risks. So I really think it's great that we are seeing that engagement from policymakers in a collaborative, bipartisan way to understand what the technology is, what positives can come out of it, but also understand some of the risks and try to get to a balanced approach where there's decent regulation to make sure that the good things happen, the bad things don't happen. Probably not the light touch we saw in the early days of the internet, but hopefully not the heavier touch that we're seeing talked about in Europe. We just got to get the right balance here in the United States so we can continue to lead it. We can lead the AI revolution just as we led the internet revolution.
And Steve, speaking of that balance, which is so important, obviously you want to foster creation and innovation. You also want to implement the appropriate guardrails necessary to have in place, obviously, to thwart some of the threats that we've been talking about when it comes to AI. From the conversations you were having yesterday with your peers, with lawmakers, how confident are you that the U.S. is on the right track in addressing the necessary issues that need to be addressed in order for AI really to continue to grow and us focus on the positive impact it's going to have moving forward?
Well, a lot of the discussion yesterday was recognizing that it is obviously an important foundational technology. The U.S. has some advantages, but China has invested very, very heavily. So if we want to win what's now this global battle, we need to make sure that we're making the right moves. And that's why one of the things we did talk about yesterday, I called for, but others did as well, making sure that this is a more distributed innovation, not just the big tech companies getting bigger, but we're opening this up to lots of startups in lots of parts of the country. There was a fair amount of unanimity around that view. The last session they had, the first AI forum just about 6 weeks ago, it was the bigger tech companies, and they were talking about some of the risks of AI, particularly the risks of open source. I think yesterday was much more in favor of more open source, in favor of more open access, in favor of more open innovation, which I thought was quite encouraging. Also, a lot of focus around the need for immigration reform. This is a battle for talent. How do we win that battle for talent? A lot of focus around regional expansion. The Tech Hubs program was launched by the president just earlier this week on Monday, 31 tech hubs. How do we build on that as part of the AI kind of response? So I thought it was a conversation that covered a lot of ground. A lot of people had different, varying views, and that's exactly what we should be doing at this stage, having all those ideas on the table as Congress tries to wrestle with us. And again, maximize benefits, make sure America continues to lead in this new technology, but also understand and try to mitigate some of the risks.
We've heard kind of the narrative, or at least how AI has been painted as a potential co-pilot, or and generative AI specifically presented as this co-pilot, or even as an ability to make sure that there is productivity that is enhanced as well. But when you think of the ultimate determining factor of how successful generative AI is, what would that be from your perspective?
really getting AI integrated into sort of key industries, the healthcare, the financial services, education, that can be reimagined using AI, technology. We're already seeing this. Again, it's not something that's futuristic. We backed a company in Chicago called Tempus that's using AI and genomics to diagnose more precisely cancer, and so they can have a more precise treatment. They just launched about 8 years ago. They have 2,000 employees. They're saving lives because of AI. AI is also being used by a number of players as sort of a tutor to help people learn about things in a much more personalized kind of way. So it's not thinking of this as a technology off on the side, kind of like the internet was. It's a technology that really can be a platform for innovation across many aspects of our lives: how we learn, how we stay healthy, how we move around, how we invest, and how using these new technologies coupled with other technologies to enable that kind of innovation. And that's what a lot of the focus was on yesterday, kind of pointing out some of the, the real benefits that AI can provide if America continues to lead and we do it in a more inclusive way, which ties in with our work around Rise of the Rest. How do we not just make sure that, the investments are going to places like Silicon Valley, the investments are spread more broadly. And as I said, the Tech Hubs program launched on Monday is an important step forward.
Steve, when you talk about the need here for high-tech talent, the competition, what's necessary in order for the U.S. in order to continue to grow, very important, and also lay the foundations for the next wave of technology, where does that stand? And I guess, what do you think are some of the adjustments that need to be made in order to make sure that we are able, that we do have access to the high-tech talent that's necessary to foster that innovation?
We're not in good shape, to be honest. I was glad it became a major topic yesterday. I actually testified in the Senate 10 years ago on immigration reform and the need to win this global battle for talent. We have not made progress. We've reversed ourselves. It's become harder to come to this country. It's harder to stay in this country. And some of the people that wanted to stay here, wanted to build here, wanted to create jobs here, have left and gone to other places. So putting more of a spotlight on that. Obviously, immigration is complicated issues. There are issues with the borders, an issue with dreamers, but particularly around the issues around high-skilled immigration, and in this case, particularly around kind of people focused on AI. We need to make sure we're a magnet for those people and they want to build here. Otherwise, we do run the risk of losing the lead we have in AI and losing our lead as the most innovative entrepreneurial nation. So hopefully, even though it's a sensitive political topic and a multifaceted topic, hopefully people can come together and Congress can pass sensible immigration reform that positions us for this next wave of innovation, including in AI.
Steve, always great to get your insights. Steve Case, Revolution Chairman and CEO, also author of Rise of the Rest. Thanks so much, Steve.
Thank you.
We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation, mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
Another price hike is coming to the streaming space, this time from Apple. The company says Apple TV Plus will now be $9.99 a month. That's up from the previous $6.99. Now, this is noteworthy because we just had some of these price changes that were announced, and that was back in October of 2022. So it seems like just a year later now, we're seeing even more price increases. Just to run through some of them, because this is going to impact Apple TV Plus, Apple Arcade, and Apple News Plus as well. Apple TV Plus, $9.99 a month. We mentioned that. Apple Arcade, $6.99 a month. That's going to be the new price. And Apple News Plus, now $12.99 a month.
And these changes take effect immediately. My big one takeaway, it's getting extremely expensive to be a streamer. And if you're relying on the streaming services, you're paying more and more and more, it seems like, almost every month, because Apple is just the latest to join several of the other services in raising their prices. Taking a look at Netflix, Hulu, Disney Plus, Paramount Plus, Discovery Plus, and Max have all raised their prices within the last year. So Apple TV Plus following suit here. They're doing this obviously to help revenue here. We know that Apple TV Plus is a growing segment, a growing division within the company. Obviously, higher prices are going to help their results going forward. Now, this is effective immediately, like we just said, $9.99 a month now, up from $6.99. We're looking at a bit of pressure here on shares, off just about 1%. But in terms of what this is going to do to subscriber churn, lots of questions about that. That has obviously been an issue with other streamers. They have so far, it looks like, at least from the results that we've seen over the last several quarters, after some of their rivals have raised prices, they were able to offset some of the churn with those higher prices, with the higher average revenue per user, which is so critical for these companies. Whether or not Apple TV Plus is going to be able to do that, I think it all comes down to content and whether or not people are willing to pay $9.99 for what's on Apple TV Plus right now.
People at Yahoo make fun of me because I use Apple Music. Thankfully for me, hey, no increases there on that front today. Yeah, just yet. Yeah, that already happened last year. But Apple Fitness Plus also has been remediated from this actual price increase that's happened across some of the other. And then the Apple One bundle here. This is interesting too. Prices for the Apple One bundles also increasing as a result. The individual one's going to be $19.95 a month, family $25.95 a month, and then the Premier is going to be $37.95 per month based on these increases that have just come across for Apple TV, Arcade, and News Plus here. I'm not sure if you're a go-to or a huge fan of any of these series that are out on Apple TV Plus, but we have apparently, according to the Slack channel here, some fans of
I like
Severance.
The morning show. I paid for it for a while, watched the
Okay.
morning show, and then it canceled it. But now I haven't seen the second season, or was it second or third season? Whatever the new season is, I haven't watched it yet. So maybe I will be renewing my subscription, although $9.99 is a little bit more costly than what I was paying last year for $6.99. But we talk about the spend. Obviously, Apple's spending more and more on the streaming service. They're trying to compete with the other competitors out there. So we'll see what that's going to do to subscriber numbers here going forward. We have more of your market action ahead live from the Nasdaq market site. We'll be right back.
All right, welcome back to Yahoo Finance. T-Mobile out with better than expected results and lifting key areas of its guidance. Let's get right to the man of the hour, T-Mobile CEO Mike Sievert. Mike, good to see you.
Thanks, Oz. Always great to be here on the floor of the exchange.
Yeah, totally. Well, normal day, and I would say a normal day for your earnings. Another beat and raise. Take us through some of the highlights of this quarter.
You know, our strategy is remarkably consistent, and you saw that that's delivering remarkably consistent performance. Another quarter of industry-leading growth, not only in customers, but in financials. I think best in the industry on service revenues, best in the industry by a mile on postpaid service revenues, which is where all the value is created, double-digit EBITDA growth, and of course, cash flows up over 90% year over year on our way to this run rate cash flow we've been talking about. So we're just in a great spot, and it shows that when you have the best network and the best value at the same time, customers respond.
How would you characterize the competitive landscape right now?
It's stable. You know, it's been remarkably consistent, but it's also competitively intense. Customers are winning. You know, they're getting 3 times more data than 5 years ago, 4 times faster speeds, and only paying a fraction of what they used to pay. They're getting better deals on phones than they ever had before, and yet the industry is also doing well. Certainly T-Mobile, you know, delivering cash flow performance that's all-time highs, $4 billion this quarter alone. So this is the 5G dividend. This is customers and businesses winning at the same time as a healthy, vibrant, but intensely competitive industry.
So you don't need to discount.
Well, you know, what's happening is customers are actually moving up our rate card voluntarily. Our Go 5G Plus rate plan that we launched this year as part of our Phone Freedom Un-carrier offer is the most popular one we offer. So think about that. The highest end rate plan we offer is also our most popular. Customers come to T-Mobile because they want this network. So they buy the offers that give them the best of it.
Talk to us a little bit about the finances of the company. So operating profits grew faster than sales. How does that continue to happen in a company like yours? Is that just the byproduct of the Sprint acquisition still playing out?
Well, it certainly has been helpful. You know, synergies, run rate synergies, about $8 billion will be achieved by next year. And so that's really been a fantastic story. But what's happening is, of course, we're attracting some of the best customers in the industry. And as we grow, we get more and more operating leverage because some of the costs of a business like ours are fixed. And so it's really turning out to be a fantastic story for our investors. As you know, last quarter we announced our first ever dividend. We're in the middle of a broad shareholder return program that we think it can be about $60 billion over the planning horizon. And then, you know, dividends that should increase on a per share basis year after year. So we're in a great spot where this company has achieved a level of scale. But the thing is, the growth isn't slowing down. So we're affording our growth, you know, and delivering results at the same time.
Don't push me off camera when I ask you this question, Mike. So should you be viewed as a regular old telecom, paying dividends, steady cash flow, and maybe growing profits by low single-digit percentages?
Well, again, cash flows this quarter up 94% versus a year ago on the strength of the industry's best top-line growth, industry's best customer growth, and we're plunging into new areas. We again delivered this quarter more broadband growth, which is new for us, 6th quarter in a row of having the industry's leading broadband growth, more than AT&T, Verizon, Comcast, and Charter combined.
There's a lot coming at consumers in this country. The return of student loan payments, inflation is still omnipresent. Do you see those stresses in your customer base?
We sure do. And, you know, it's not showing up in bad debt metrics. Customers are paying their bills reliably. In fact, T-Mobile customers pay their bills more reliably than our benchmark competitors. But there may be what's happening, maybe a bit of a flight to value. And that's great for T-Mobile. You know, we're here to serve customers at lower prices. But at the same time, we offer the best network. And, you know, when customers are feeling the pinch, they may ask themselves, do I have the right provider? Can I have the best of both if I look at T-Mobile? And for a lot of customers, the answer is yes.
It's also a time of rising interest rates. We talk about this every single day on Yahoo Finance. Your company has debt. Does this environment change how you operate the company next year?
Yeah, it does. You know, we actually announced at the same time we announced our dividend program that we would move a little faster than planned to our target 2.5 leverage ratio. And we'll get there by next year from a 2.7 and change right now. So we're managing our balance sheet accordingly with the rising cost of interest. But remember, we also are moving into more and more investment grades. And so, you know, 2 years ago, we were not investment grade. We achieved investment grade and then got corporate family investment grade. So we're one of the only large issuers with a falling cost of capital because in the backdrop of a broad interest rate environment, we're getting more and more investment grade and realizing the benefits of that.
This has been a big year for company. I think I caught up with you around the All-Star game. You were out there marketing for that. What are some of your priorities for 2024 to the extent you can share them today?
Sure. It's all about growing customers, taking share. We have so many under-penetrated audiences. This quarter, Q3, was the first time ever we achieved switching leadership in smaller markets and rural areas.
That's people switching from other providers to you?
Yeah, share-taking leadership for the first time in the 40% of America that's not the top 100 cities. That's amazing. We started out as a distant number 4 there years ago, and now we were the #1 share taker for the first time ever. Look at enterprise and government, where we have share in the low teens as opposed to 35-40% where you would expect us to be over time. We said we'd get to 20% by 2025, and we're right on track. So we have a number of places, broadband, where we're very under-penetrated relative to what the best network and the best value should get us to. And so growth, share taking, and pursuing those under-penetrated markets.
And look, Mike, next year we're going into election season. Do you think about that as a leader? And does that alter how you message things out there on the internet or online or on TV? Do you think about those things now?
Of course I do. It's interesting. Today it's so different than it was 5, maybe even 10, 5 years ago, in that companies are expected to be forces for change and forces for good. Business can be one of the great platforms for societal improvement. And so we take our responsibilities not just to shareholders, but to the broader community very seriously. But this is going to be a crazy political season. Our company serves people from all walks of life, so you won't see us taking political stands, but occasionally you may see us needing to take a values or morals-based stand.
Lastly, before we let you go, this is a challenging time for leaders. Everything we've seen, of course, in the Middle East. Over the past 2 weeks, what has been your message to employees inside of T-Mobile when a lot of them, I'm sure, are uncertain about what may happen next and just in general?
Well, I did reach out to employees about the conflict and about the violence that we saw happen. And what I talked about was the chance for us to lift each other up. We are a community of people that support each other, listen to each other, and lift each other up. And some of our employees are hurting because of all this. This isn't just a news item for some of our employees. This affects families and loved ones and culture and heritage and tradition. And so being respectful, listening to each other, supporting each other as a small community is really important.
All right, T-Mobile CEO Mike Seaver, thanks for always being gracious with your time for Yahoo Finance. We appreciate it, and we'll talk to you next quarter.
Great to see you.
All right, appreciate it. Guys, back to you.
Welcome back. Tech workers are increasingly returning to in-office work. That's according to a new report released exclusively to Yahoo Finance first. The sector's share of U.S. office leasing activity grew in 2023, hitting 16.5% in the third quarter. And it's all thanks to a surge in funding for artificial intelligence companies. That's according to CBRE's annual Tech 30 report. With more on the office landscape for tech is Colin Yazzukochi. He's the executive director of CBRE's Tech Insights Center. Colin, thank you so much for joining us this morning. Let's get right into kind of the headline for this report. Talk us through what was your number one takeaway.
Yeah, so we saw the tech industry continue to add jobs in 2023, although that growth slowed down pretty significantly. But what's amazing is that with all the layoff announcements that we've been hearing, that there's still companies who are hiring tech workers. And one of the areas, as you had mentioned, is the artificial intelligence sector, where we are seeing a significant growth in both job additions as well as commercial real estate acquisition.
Now, AI seems like kind of strange bedfellows when you think about commercial real estate. I mean, it's artificial intelligence, Colin. So how does that play out in terms of the relationship between AI and office space now? Why is there even a need?
And that is an interesting point, because it sounds counterintuitive, but you really need human intelligence to create artificial intelligence. And this is such an emerging area that people need to be more together to collaborate and innovate. And that's ever more important. And so that's why we're seeing, especially in the San Francisco Bay Area, that artificial intelligence companies that are high growth are taking more office space so they can accommodate that interactions in person and to continue to grow and innovate.
Well, commercial real estate, we know, has had a lot of challenges this year, and there's concerns about where it stands now in the industry. Can AI be a savior of commercial real estate?
It can certainly be a start in terms of a catalyst for what the large next tech growth cycle might be. At this point, artificial intelligence is probably too small of a sector within tech to really turn the real estate market around quickly. But we feel that they can create a platform that's going to lead to a lot of new business creation and create a wave of growth similar to what we saw after the great financial crisis, and the mobile internet created opportunities for businesses that just couldn't exist before.
And we know there are like boom and bust cycles when it comes to tech. You and I have talked about that offline. So what does the data show you in terms of the patterns that we're seeing, especially in terms of any surprising findings in your research this year?
Yeah, so over the last, I would say, 5 years, and even in this year's report, we've still seen a lot of growth in the tech industry in Canada. So Vancouver was actually our top market in terms of creating tech jobs in 2021 and 2022. And so there's been a lot of growth in Canada. We've also seen a lot of smaller markets see significant amount of growth. Interestingly, Waterloo in Canada, which is just outside of Toronto, was one of those markets. Also Colorado Springs and Kansas City. In addition to some of our larger markets that we still feel very confident about, those being New York City, which created the most jobs in terms of pure numbers, and the San Francisco Bay Area because of AI and what that represents in terms of growth.
And what did you see in terms of the footprint shrinking? Were there any large markets where you saw the footprint shrink in terms of office leasing activity?
Yeah, so there's definitely been a overall trend of tech companies taking less space, and that's why we've seen office vacancies rise. But now we're starting to see companies require their employees to come back at least 2 to 3 days per week, and that seems to have stabilized the market, at least for now. And once the economic situation solidifies, we think there's going to be a very strong growth in the tech industry that's going to lead to much higher demand for office space.
And then in terms of the outlook for 2024, what does the data show you in terms of patterns, especially when we think about, say, startups in the AI space or these established heavyweight tech companies?
Yeah, so interestingly, what we do look at as being the leading indicators of where the tech industry is headed is the performance of the stock market, particularly the Nasdaq, and the level of venture capital funding. Both of those are doing pretty well, especially the stock market. Venture capital funding has probably come down a bit in the last couple of years, but it still remains at historically high levels. And that's especially true for AI companies, where we're seeing not only big venture capital investments, but big investments from big tech companies that are, wanting to be on the cutting edge. And so we're very optimistic about the tech industry long term, although, things could be a little bit up and down over the next 6 to 12 months. But we look forward to very strong growth by the second half of 24 or into 2025.
All right, Colin, thank you so much for giving us the exclusive on this. Our thanks to Colin Yasukochi, the Executive Director of CBRE Tech Insights Center. We'll have to put a pin in our conversation. Thanks, Colin. And with that, I'll send it back over to Brad Smith over at the Nasdaq market site.
All right, thanks so much, Diane, for that interview here. Everyone, we've got just a few seconds left in the 10 a.m. hour. Let's take a look at the markets. Just a brief gander at the U.S. major averages was have us down across the board. The Dow flat just barely to the downside here. The S&P 500, that's lower by about 0.8%. The Nasdaq Composite, you're seeing that lower by about 1.5% right now. Sectors as of this point in time, 90 minutes into the session, roughly largely in negative territory here. I'm taking a look at the Wi-Fi Interactive here. I've got it on my laptop for you folks at home. Utilities right now, that's in positive territory, as well as staples. But really, those are the only two bright spots as of this point in time, as you've got XLRE and XLC, which are pulling up the boost. Of course, there's communication services stocks, those represented in XLC there. You're seeing that down by about 3% here. And then since I mentioned XLRE, you're seeing that down about 1.5%. But hey, I don't need to give you much more info as of this point in time. Why? Because we're sticking around for the next hour, and we've got much more to disseminate and bring your way. More to come on Yahoo Finance. From Brad Smith, Sean Smith, and the entire team. We'll see you in about 2 minutes, 30 seconds. Welcome back to Yahoo Finance, everyone. It is 11 a.m. on the East Coast, 8 a.m. on the West Coast. I'm Brad Smith here with Sean Smith, and here's what we are watching this morning. Cloud is the word of the day. Storm clouds for investors amid a mixed earnings season and elevated yields. Cloud computing issues for Alphabet as it leads the market lower here, and cloudy weather for Boeing as it cuts its 737 MAX delivery forecast here.
All right, Microsoft was tech's big winner on an AI-driven outperformance there, but what's coming up on the gaming front? More on what to expect now that Activision Blizzard acquisition has the green light.
And the dangers of driverless cars here. California is ordering General Motors to pump the brakes on its Cruise unit over public safety concerns.
But first, let's get a check of the markets here. We're seeing some pressure across the board. You can see all three of the major averages here at the top of the hour. Under pressure, although the Dow just below the flat line. You're looking at the S&P off just about 0.7%. The Nasdaq, though, the biggest decliner of the day. A lot of that has to do with the earnings reports that we've gotten out over the last 24 hours. Google, Alphabet really disappointing here in terms of the cloud performance from the company. That's pressuring sales. And you can see it among the big decliners of the big tech names, with Google shares off nearly 9% right now. On the flip side, Microsoft helping to stem some of those losses, at least. They're pretty strong results. Some optimism there within their cloud. Growth is pushing that stock higher, up nearly 3% here. Checking in on yield, we're seeing some movement to the upside. The 10-year yield pushing up just about 6 basis points to 4.9%. Well, the last major piece of data the Fed is going to get before the decision on November 1st releases this Friday, and that's their favorite inflation gauge, PCE. Core PCE, which excludes the cost of food and energy, is expected to cool in September compared to August's print, rising 3.7% year over year and 0.3% on a month-over-month basis. Now, in his latest remarks, Fed Chair Jerome Powell saying that he intends to proceed carefully, given the bond sell-off and other macro risks, but still reiterated that the 2% inflation target. So what does a data-dependent Fed need to see from PCE and other data points to feel good about the inflation fight? We want to bring in Marvin Lowe. He's State Street Senior Global Macro Strategist. And Marvin, let's break this all down, right? Because lots of anticipation about what we're going to get with this inflation print on Friday, but the movement that we've seen in yields, that has certainly come in focus, whether or not that's going to add enough pressure on the economy for the Fed to stay put. What do you think, and do you see us moving further past potentially that 5% level in yields?
Yeah, I mean, for certain, I think the Fed is not going to go. I think they're going to skip again, ultimately because they told us. So we'll follow like the sheep that the market is when it comes to some of these Fed conversations. The real question is that when you kind of look at their projections and you kind of look at how the economy is performing, we're going to get GDP for the third quarter, which looks very, very strong. You have to question whether or not they should go. We don't think that they're going to go. We think that they actually are probably done for this hiking cycle. But kind of having said that, the data remains hot, and it does create some risk that they don't get to that 2% number.
And Marvin, when you think about what the Fed is going to need to signal in order for the markets to believe that there is not going to be a deep or hard recession, but perhaps, as some economists have been predicting, a more shallow recession, what do you need to hear from the Fed on that?
You know what? I don't think, to be honest with you, I don't think that they can provide the comfort in their expectations to get us to a point where we're going to start believing in the soft landing. I think that once they've gone to this data-dependent route, they've really created a lot of risk in terms of just how volatile and just how uncertain they are about how the economy is going to evolve. And as a result, we've kind of seen 10-year yields, the longer part of the curve, trade a bit unhinged relative to what we saw in the middle of the year. And that's really creating the volatility in the market. And that's really making, if you will, some of these more exaggerated moves on the equity markets on any given day.
That's really interesting. So, as you're kind of putting that thought out there, and I mean, we've heard time and time again how data dependent the Fed is going to be, but yeah. I think that's the first time that I've heard that from what you said, and that them signaling that they are going to be more data dependent doesn't exactly put a soft landing in the equation, because then that means that they're going to continuously be looking at some of the more backward-facing or rear-view mirror data when we're trying to figure out, all right, what's in front of us right now.
Yeah, absolutely. And, I think, their intention certainly was to go all in on the soft landing, go all in the, higher for longer kind of message that they've been providing. In September, however, I think they created a set of economic forecasts that I've been calling the impossible trinity. So, relatively strong growth, unemployment that really shows the economy only slows to a full employment level, this kind of NAIRU number that economists like to talk about, and inflation ultimately taking 4 years to get to 2% doesn't really instill a great deal of confidence that they've got a handle on what it takes. So between September and where we are now, we're going to have a strong GDP print. We had a strong employment print. We had a stronger than expected CPI print. That really signals that, maybe the job isn't done. And Chair Powell actually talked about, if we looked at the evidence, we're not restrictive. From that perspective, if we're not restrictive and we still are far from those targets, we should be hiking, but they're not going to. And that ultimately creates some risk in terms of what are they really looking at? That's what the markets really want to know. What is driving their kind of policy thought rather than each data point?
So then, Marvin, I guess diving just right into it, what does then that mean for equities action, that we could see the volatility that could likely be a result of this?
Yeah, for sure. So, I do believe that higher long yields do equate to a certain number of rate hikes. But the higher long yields have been driven by real yields, and they've been driven by term premium. And all of that is, all of those are points that other risk assets need to now compete against. Kind of the inflation discussion in kind of this break-even expectations is sometimes a little bit easier because equities in particular are nominal earning vehicles. They can benefit from inflation if they could pass it on. But that real yield is like, we need a higher number to compete with that real yield. And as that goes up, because there's less comfort, if you will, with the Fed actually having a handle on getting to that 2% number, then you have volatility in the equity markets. And, by all accounts, equities aren't cheap at this point. And we see just how one earnings release, how expectations around that creates the volatility that, we've really started to see across some of these companies and certainly markets.
Marvin, we only got 30 seconds left. I got to hustle to the finish here, but what is your top global strategy right now?
You know what? I think keep powder dry. Cash is about as boring as you can get, but you're earning over 5% of it, 5% on it. I do like bills. I like leaning into a little bit of duration if you like the income, but certainly be nimble.
Marvin Lowe, who is the State Street Senior Global Macro Strategist here. Marvin, we got some big headlines that you just tossed out there. The Fed's impossible trinity.
Thank you.
We might be using that here. Thanks so much, Marvin. Really appreciate the time and insights. Thanks. Well, the Bank of Japan is expected to unwind its negative interest rate policy in 2024, and the fallout in U.S. Treasuries could be huge. Here with more on this, we've got Yahoo Finance reporter Inez Ferre. Inez, what is the expectation here?
Yeah, Brad. Well, the Bank of Japan has been kind of moving in opposite directions to other central banks that have been tightening their monetary policy. The Bank of Japan, back in 2016, started this sub-zero interest rate policy, yield curve control. That's where they buy bonds to target certain interest rates and to control certain parts of the yield curve, usually the 10-year Treasury yield. And this is very significant because now the expectation in the market is that the Bank of Japan is going to reverse to end that sub-zero rate policy in the first half of 2024. And what happens when the Bank of Japan does that? Well, the market is expecting that to have ramifications in other parts of the world. And just to back up for a second, Japan's 10-year Treasury yield is right now at below 0.9%. That's compared to the U.S. 10-year Treasury yield, for example, that's around 4.9%. It had topped 5% for the first time since 2007 this week. But this is important because if yields for Japanese treasuries become more attractive, if they're more attractive locally, then that would mean that Japanese investors would start to flow money back into their own country, because that would impact the flows of money to other treasuries, including U.S. treasuries, including Australian treasuries, also European treasuries. And this is important because Japanese investors are the biggest holders, foreign holders of U.S. government bonds. And a Bloomberg survey shows that 61% of respondents are expecting global bond market volatility to spike when the BOJ changes its policy. And already we have seen volatility in the U.S. Treasury market. As I was mentioning, you have U.S. debt that's higher, you have government spending that's higher, interest rates that are higher. So what that has done is that it has made the Treasury Department basically issue more treasuries, more bonds, more notes, and that has created volatility in the market at a time when other central banks have sort of pared back their buying of U.S. treasuries. So it'll be interesting to see how the BOJ's actions impact treasury markets around the world.
Something we will be watching. All right, Ines, thanks.
Thank you.
Well, FTX founder Sam Bankman-Fried is going to take the stand to testify in his own defense. His attorney revealing in a conference call this morning that the former crypto tycoon now has an adequate supply of his ADHD medication, making him able to make this move, which some consider pretty risky. It's very risky, and I think that's safe to say, right? A lot of times this is viewed as almost a last resort when you run out of other options here. You're most often try to avoid this during criminal cases, but this comes following testimony that we've gotten from a number of his former colleagues, and many of them, Caroline Ellison being one of them. She was the CEO of Alameda. FTX's former head of engineering, Nishad Singh, also Gary Wang, the co-founder of the crypto exchange, pleaded guilty to fraud, but they're cooperating with prosecutors, and all three on the stand really pointing to SBF and his involvement, and that he was the one that was behind the misuse of customer funds, which we know is obviously at the heart of this trial. So the fact that he is expected to now take a stand later this week when the defense begins its side of the case certainly just signals, I think, the direction of this trial so far, and almost that there was no other option left in order other than for him to try and make his case at this point.
Right, very much a what do we have to lose type of strategy here. And you think about the charges here that he has pled not guilty to at this point, criminal charges including securities fraud, conspiracy to launder money, wire fraud, and those are just among a few of them. As you continue to think about how this plays out and what is also going to be taking place in tandem within the broader crypto world, crypto is still looking for and has finally got a bit of that way forward here, but it's not come in the form of an SBF. It's not come in the form of a CZ. It's come in the form of the SEC and ultimately finally having to look at the ETFs that have been submitted for approval and perhaps a blanket and sweeping type of approval process that could take place there to provide further validation for the broader crypto landscape here. And so the reason I bring that up is because so many of these figureheads were looked at for quite some time as the people that investors within crypto would have to find some weight around, find reasons to really have a belief in the whales and the long-term holders and the largest holders of crypto and the stalwarts of the industry, or at least gatekeepers of it, to say, okay, because they're doing successful, because they have all these innovative ideas, then crypto will do well too. Well, many of them have found themselves either in some type of proceeding, whether that be a criminal or a more civil proceeding that's taking place. For this one, it's certainly going to be watched. But I think if there's one thing that we take away from this, it's that there isn't some key figure that's just going to be one to rule them all in crypto. It's really more so how can, for the thread and for the tenor that was put forward at the beginning of this in the white paper from Satoshi from the start of this, how can this be more decentralized? And decentralization doesn't mean one core figure. It means many people having the opportunity to take part in the growth of a broader and newer type of financial system as well, too.
Yeah, certainly. We'll see if we learn anything new, but I think it's safe to say that testifying in your own defense case, obviously very, very risky, but I think many eyes will be paying close attention to what we hear from the courtroom in the coming days. All right, keep it right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back.
Microsoft's cloud division shined brightly in its most recent quarter. The tech giant's push into the AI space boosting its overall performance. Azure grew 29%, up from 26% in the previous quarter. But let's not overlook gaming here. While device revenue took a hit during the quarter, Xbox content and services revenue increased 13% from the year prior, and the company's gaming division has a lot to look forward to. Microsoft closed its $69 billion acquisition of video game maker Activision Blizzard earlier this month. With more on what the future holds for Microsoft in the gaming space, let's bring in Yahoo Finance's Chief Gaming Officer and Tech Editor, Dan Howley here. Dan, what is the significance of this and this finally coming to a closure?
Yeah, Brad, CGO, good title. I'm going to stick with that and ask for a promotion now. Thank you very much. This is a big deal for Microsoft. This is something that they've been trying to get done for years now, and now it's finally closed. Caveat that with the fact that the FTC is still trying to fight it and may work to attempt to break it up if they have their way. But let's put that aside for now and look at what it means for Microsoft moving forward. In the quarter, Xbox hardware revenue was down. That's not really, too much to go by. If you look at Sony, they're still crushing it with Sony PlayStation sales. But as far as Xbox hardware goes, you expect that to probably start to ramp up in this current quarter because of holiday sales. The big thing, though, was they had a surprise increase or jump as far as Game Pass subscribers. That's according to Amy Hood. As you said, content and services, that's up 13%. That includes game sales as well as Game Pass subscription. That's really where they're trying to go. That's their, I hate to say it, but their North Star for gaming, where they want consumers to subscribe, have that recurring revenue over time, and perhaps eventually increase prices. Right now, it's a steal basically. I believe it's $15 a month around there for access to these games. And so, with Activision Blizzard, they're just going to be adding on those additional games and titles to get people interested. And, outside of the UK, which has a carve out for its Game Pass and cloud services. You'll be able to get all of those through Game Pass. So that's the Call of Duties, the Diablos, all of those titles that go with Activision Blizzard will be available on Game Pass at some point. And so you have to imagine that when it comes to Microsoft's gaming division, this is going to be a boon. Now, we don't have exact breakdowns of the numbers specifically for Game Pass as far as revenue goes, but they're increasingly leaning on that and calling it out. And if you look at the last few quarters, the CTO Satya Nadella had specifically mentioned Xbox and Game Pass as a big win for the company. So, this $69 billion deal is done. We're going to see them start to push the games into Microsoft's library. That's going to take a little bit of time, but once it starts to really hit, I think a new Call of Duty comes out. It's available on Game Pass. It's $15 a month. Why not sign up for it and get the game? And then, get access to a slew of others. You don't have to spend the $60, $70 on a game right now, and you get access to more and more down the line. So I think it basically is going to start to sell itself now.
All right, so we're going to watch. Dan Halley, thanks so much for breaking that down for us. Again, Microsoft shares up just about 2.5%. Well, hotel giant Hilton earnings beat the street's estimates this morning. Slowing leisure travel in the U.S. was offset by strong demand for international trips. Now, with more on what this means for the hospitality industry at large, we want to bring in Chad Beynon. He is at Macquarie's senior gaming, lodging, and theaters analyst. Chad, it's good to see you. So lots of talk just about whether or not revenge travel is over, given the slowdown that we're seeing here domestically. What do you think?
Sure. Thanks for having me. So, yeah, I'd say leisure travel, kind of the typical revenge travel, was very strong in the past 12 to 18 months. Everyone who was kind of cooped up in their house was going on these once-in-a-lifetime types of trips, and there was no price elasticity. What we're seeing right now is the group business, so association, corporate, weddings, those types of things, and the traditional roller bag business travel come back. So those segments have lagged a little bit during the past 18 to 24 months, but that's kind of where we're seeing the growth. And as you noted, in the third quarter, Hilton exceeded guidance and consensus expectations for rate and occupancy for the quarter. They exceeded on EBITDA. They raised Q4 guide compared to where consensus was. And they also gave a little bit of a look into 24 in terms of room rates and unit growth as well. And that was positive. Now, the stock has been working, and we are near 52-week highs. So this is a company that's beaten 10 straight quarters. I think that's why we're seeing the soft move today, but really good set of results that we saw.
When you think about the capacity that they're going to be bringing online as well, Chad, how do you expect that to also deliver to some of their longer-term ambitions?
Yeah, I'd say Hilton plays a little bit more towards that mid-end of the corporate and leisure travel space. People have been looking for them to move upscale slightly more for chain scales. Now, that usually benefits from the corporate flyers and stayers who want to use personal stays at some higher end properties. So it usually doesn't drive, as much kind of in the quarter, but some people are loyal because they want to stay at properties, in the right city, at the right location, or on the beach. But yeah, they've done a really nice job. They have over 170 million guests at this point in their system, and they're driving them more to mid-end properties in North America and abroad.
I love a good beachside stay, Chad. When we think about ultimately the competitive landscape here, we just saw what is potentially going to be a hostile takeover attempt between two other players within this industry. Do you expect more consolidation, or at least kicking of the tires of some of the deals within the accommodation space, as many of them are still reacting to and trying to get ahead of any type of furthering of a consumer that prefers staying at a rental that's listed on Vrbo or listed on Airbnb and not at one of these historical hotel chains?
Yeah, it's a great question. I think for Hilton and Marriott, kind of the major gorillas in the space, they've looked at some small acquisitions in the past couple years, kind of bolt-on areas, kind of where they can't franchise or manage on their own. Some of the other companies have looked to grow more substantially. we're still seeing synergies that we would see historically. Marriott made an acquisition, I guess it's been 7 or 8 years ago, acquiring Sheraton, and that was a 10 billion plus acquisition. We haven't seen much acquisitions in the space, and I think the main reason is because the business model is phenomenal, right? You have infinite returns. Essentially, these business models are just leveraging their reservation systems, their connections, their loyalty, membership groups. And there's really little need to make major acquisitions. A company like Hilton spends over $2 billion buying back stock and issuing a dividend, and that's kind of where they want to deploy their capital. I think Marriott's in the same area. So these are companies that are going to grow 5 to 7% over the next several years. They have good signings, good pipeline, and I can't see them doing other acquisitions. But in terms of some of the smaller companies, I do think that is something that could help those companies move up in terms of memberships. And that's what you're noting here that we saw earlier this week.
Chad, it was a strong quarter here from the company like you referred to here in your most recent note, also on here with us. But when you talk about the beat that we saw in the third quarter, the raise that we saw for the current year, looking ahead to 2024, I know you still have a hold rating on the stock. What's the catalyst, or what do you need to see in order to be more bullish on this name?
Yeah, we prefer Hyatt within the space right now. They lean a little bit more towards wellness, towards luxury. They still own some properties, so there's some catalyst that could come in terms of selling assets. Hilton, the main reason why we're neutral is really just kind of where their chain scale is. I think there's going to be some slight underperformance at that mid end just because of what we're seeing with the consumer. The mid to high end, corporate luxury, we'll be able to push prices, and we're kind of seeing that in the data, the forward data for 24. So that's probably the main reason. It's really just kind of a comparison versus some of the others. That said, Hilton's guide for this year and for 24 do bode well. It's a phenomenal business model. It's a great company that should always, in our view, trade above 20 times earnings just because of the franchisee aspect. So I think what we would need to see is probably an acceleration in leisure travel from where we are right now, and then that mid-end consumer having more purchasing power. I think those are the two major things right now. We have a $152 price target, so we'll reevaluate based on what we learned today.
Chad, always great to get some of your analysis and insights on the industry. Chad Bynum, who is the Macquarie Senior Gaming, Lodging, and Theaters Analyst. Thanks so much for taking the time.
Thank you. Have a good one.
You too. All your markets action ahead. Stay tuned, everyone. You're watching Yahoo Finance.
Oil is in the red once again today, with crude selling off for the fourth day in a row. This comes as speculation that the Israel-Hamas war could potentially stay contained with diplomatic efforts going on in the region. We also want to mention the decline that we got in the recent data coming out from the U.S. government data revealing weekly gains in domestic crude and also gasoline inventories there. So prices further declining on the latest supply readings. Jared Blicker standing by with the latest on the movement that we're seeing within the oil market. Jared.
Hi, Shauna. Let's go straight to the Wi-Fi Interactive, where I have crude oil up, and you can see we got a little bit of a dip. This was on the government report that you were just talking about, where we saw a rise in crude oil inventories. This is a weekly report from the Department of Energy, 1.372 million barrels. Now, that was a surprise because the street was expecting a draw, so a negative 450,000 barrel. When you get the sign wrong, sometimes you do see some movement there, but not a huge deal in the big picture of things. Let me put a year-to-date chart, and you can see here we got this spike to above $90 per barrel, about 95 in there. That was on the beginning of the most recent conflict. That kind of pales in comparison to what we saw last year with Russia invading Ukraine. That did cause a lot more disruptions. Nevertheless, market participants are already looking ahead to the next OPEC Plus meeting. That is going to be happening next week, and expectations are that they're going to hold. So Saudi Arabia and Russia have been holding supplies. They've been actually holding back 1.3 million barrels per day. That's excess capacity that could theoretically come back at any time and help lower prices. But guess what? The Saudis and OPEC Plus, that's their cash cow. So they want to see crude oil at above $100, ideally $110. And when we're talking about that, it's really going to be Brent, because that's the pricing that we use there. A few dollars more, and this is more of a European and Asian grade that Asian importers use. And we can see there a very similar chart, but nevertheless a couple dollars higher there. And just in general, I want to talk about the energy market. Year to date, energy is actually down. It's almost break even, but down ever so slightly, 0.4%. And you can see this is a 2-year chart. Let me put that on 1 year to date. You can see some vicissitudes in there, but over the last 3 months, we've really seen actually a little bit more of that. Let me put a 6-month chart in there. You can see a little bit more gains. We had one area of trading that would do a trading range to the bottom, and then we have this trading range we've seen since August. And in that time period, let me just put a 3-month show. Energy is the only sector that has been in the green while the general market has rolled over. We saw the markets peak in late July, very end of the month, and then August was down, September was down. October is looking like it might be down as well in the general market. So we'll have to see what comes of this. Finally, I just want to show you what's happening in the energy space. This is over the last 3 months. Let me just throw this into a year-to-date look. You can see for the most part, more green than red. And also got to say that given all the pricing and given all the declines that we've had in stocks in general since last year, and the fact that energy is finally rolling over a bit from those high prices that we saw last year, we're seeing mergers and acquisitions, the latest being Hess, for instance, and that's where a lot of the outlier activity is coming from. We are looking forward to Exxon and Chevron earnings coming up, and so we will be bringing those to you some fine morning when they report.
All right. Yes, indeed. Jared, appreciate it. Thanks so much. Well, AI is still drawing a lot of attention, especially now that we're in another earnings season and the tech portion of it kicking off here. And investors are noticing the wide array of applications that AI tech can have. But choosing wisely amid the influx of stocks and funds, as well as a vast amount of movement in the space, can be challenging. So how do you fit it into your portfolio, should you so choose? As part of the ETF report brought to you by Invesco QQQ, let's bring in ETF think tank Director of Research, Cynthia Murphy, to discuss more. So, Cynthia, great to discuss this with you this morning. As you think about where you're seeing some investors take stock of where AI is going to have the most immediate applications and where some of those long-term opportunities are, how are you seeing people include this in their portfolio from an ETF perspective?
Hey, I'm excited to be here. This is a theme that, it started the year on all gears. It was super hot. It went into hype mode. And, maybe to a lot of our surprises, it actually has stayed hot. And I think it's It's a space that investors are seeing as must own. And for companies that are, on any industry today, it's almost like AI now is just table stakes. You have to have an investment in it. You have to be developing your technology. You have to be doing things in a smarter way. So it's no longer like, a cherry on top. It's just like you have to have it as a building block. So from an investment perspective, it's been a really interesting space to watch because there's so many ETFs out there. I mean, you start off with the concept of ETF to access the AI story. If you're already concerned about how do you even know which companies are going to win in this space, who's going to survive, who's going to have the leading tech, who's going to fall behind, who's going to be acquired by who. So the concept of an ETF is attractive to a lot of people trying to access AI as a theme because you get the diversification. You're not putting all your chips in one horse. You're kind of betting on the race in general. And even in that, there's so many ways to slice and dice the space. I can tell you in general, whether you're going to go broad or whether you're going specific on, say, robotics or whether you're all in on generative AI, we're seeing asset flows into all of these sleeves of all these parts of this theme. So it's a space that it has been surprisingly resilient, even though there's been so much concern about growth. There's been so much concern about high cost of capital. A lot of these are big growth names, but the money is flowing, and it's a trend that we don't see stopping anytime soon.
Cynthia, when you talk about the fact that maybe this trend won't stop anytime soon, a lot of investors very excited. They want exposure to AI. So what are the best ways you think to play the sector right now through ETFs?
So there's many ways to slice this. I think you can think of it in maybe three easy buckets, if you will. One is just your broad catch-all type of take. There's a lot of actually veteran ETFs in this space, like 5-year-old funds, way before AI was a big hype. So, funds that are broadly diversified. So tickers like AIQ come to mind, or IRBO from iShares. These are funds that invest in the entire value chain of artificial intelligence, robotics, technology. So they'll own the hardware names, they'll own the software names, they'll own the creators and the applicators, if you will. The choices there, if you're going to go with that type of approach, super diversified, is actually what level of diversification you want. On AIQ, for example, you're getting like heavyweights, big market cap, lots of tech. You go IRBO, it's an equally weighted portfolio, tilts a lot smaller, and you get a very different mix of names in there. You even have a fund like a company like MicroStrategy in there, which is known in the Bitcoin space. So you have to really take a moment to look at what type of exposure you're getting and what type of concentration you're getting on specific names. The other bucket that's a super popular bucket would be your robotics automation type of bucket. ARC is a big player in there, big brand in that space. But you have some, like your battle between things like Robo, ROBO, and bots, BOTZ, and there's many ETFs in the robotic space. Again, it becomes a decision of, do you want to invest in the creators, the softwares, the developers, which would be, for example, a Robo, or do you want to invest in the applicators, the companies that are implementing AI and robotics to do their businesses better on a day-to-day basis? That would be bots. So if you look at a fund like bots versus Robo, bots has a lot of industrial names, healthcare names. It's not your classic super tech fund. And it's really popular. It has $2 billion in assets. It's picked up, I think, almost $500 million so far this year. So the application of automation and robotics is a popular way to access the story as opposed to just the companies creating. And as a final one is, the hype this year specifically is generative AI. And so we're seeing product development on that front. Chat, CHAT from Roundhill is a big name in there. It's only 6 months old, and it's already picking up almost $100 million in assets. So it's another way to go.
All right, Cynthia Murphy, thanks so much for giving us some insight there and ways to play the AI space through ETFs, ETF Think Tank Director of Research. Thanks, Cynthia.
Thank you.
All right, we've got all your market action ahead live from the Nasdaq market site. We'll be right back.
This is a North Star. We know where you and a lot of, probably half the American population wants to be in terms of having just EVs being sold after 2035.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation, mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it November 7th, exclusively on Yahoo Finance.
The dangers of driverless cars. On Tuesday, the California Department of Motor Vehicles ordered General Motors' Cruise unit to suspend its driverless cars over public safety concerns. Yahoo Finance's Pras Subramanian has the latest on that story. Pras.
Hey, Shauna, not a good day for GM yesterday following pulling its guidance due to the UAW strike, holding back on its EV expansion. And then, as you mentioned, it's got its AV license pulled in the state of California for Cruise due to safety concerns. California says that GM misrepresented information about a safety and tech of its vehicles. This comes after a series of accidents, but one in particular really sticks out. A woman was hit by a vehicle and thrown in front of a Cruise vehicle, which then stopped on top of her. What Cruise didn't show was that the DMV was that after that, the Cruise vehicle traveled 20 feet at 7 miles per hour, dragging the pedestrian along with it and potentially causing further injuries. This is according to the DMV. The DMV says subsequent maneuvering of the vehicle indicates that Cruise's vehicles may lack the ability to respond in an appropriate manner during an accident. And for its part, Cruise says it's working with the DMV and NHTSA to aid their investigation and enhance the system. Cruise is pausing, as you said, driverless AVs in San Francisco. But the DMV says Cruise can operate and continue pickups as long as there's a safety driver monitoring in every AV.
Pras, there had been some focus around Cruise as GM had been expected to spin off this unit, and they've year after year after year, it seems like, pushed back against that notion. Do risks like this kind of cause them, or does that trigger any kind of rethinking rather around that?
Yeah, I mean, I think it's hard if you're an investor to invest in a company that potentially may be injuring people who are in the vehicles or outside the vehicles. You mentioned the Cruise was valued at multiple billions of dollars as only a couple of years ago, and then what happened was that you saw a lot of the AV theme sort of lose momentum. You saw Volkswagen and Ford pulled the plug on their autonomous venture there. They're trying to actually focus more on sort of like assisted driving and adaptive cruise control, things like that. And so not level 4, level 5 autonomy, but more a little bit more below that. So I think Cruise has been a pretty ambitious project, and they really want to see autonomy happen. The question is, how soon will that be? And it seems like with these different struggles, in addition to the EV struggles at GM, it might take a lot longer than people think for when we actually might have full autonomous vehicles and robo-taxis like Elon Musk is sort of espousing.
Yeah, all right. A lot of work to still do, it seems, at least at this point. Pras, thanks so much for keeping tabs on this part of the GM business and more broadly, the ambitions for self-driving cars out there. Thanks, Pras. Sticking with autos, consumer demand for electric vehicles, well, we know that's risen drastically over the years, and more states across the U.S. are looking to ban gas-powered cars. Democratic Connecticut Governor Ned Lamont recently proposed regulations to make cars and trucks cleaner to help reduce the state's air pollution. Yahoo Finance anchor Rochelle Akufo spoke with Governor Lamont on the push for cleaner cars, the long-lasting impact of the UAW strike, and job creation among the auto industry. Take a listen.
This is a North Star. We know where you and a lot of, probably half the American population wants to be in terms of having just EVs being sold after 2035. Makes a big difference because most, Rochelle, of the pollution in our state, ambient pollution, is related to automobile and truck traffic on our highways. So if we can reduce that by moving people to EVs, that's a good thing for the industry and that's a good thing for our environment.
And it can be tough, though, because for a lot of people, they're sort of seeing some mixed messaging here, especially as we think about the UAW strikes. I mean, you have President Biden, who was on the picket line with workers, but then you had former President Trump at a non-union shop saying, look, it doesn't even matter what sort of deal the workers work out because EVs are going to kill your jobs. So in terms of the messaging that's out there, do you think it's being conveyed in a way that can actually get voters encouraged and on board?
I hope so. We're going to be producing these cars, we're going to be producing the batteries, you're going to be installing EV charging stations. It's going to be a different type of job, but like all new industries, it's going to be a job creator at the end of the day. So I understand the hesitancy of some of those that make the internal combustion engines, oh, woe is me, let's not change what we do. But I think it's progress, and I think it's also going to be progress in terms of good paying union jobs.
But do you think we're going to see that sort of bipartisan support, though, especially in a divided Congress?
Oh, I didn't say that. I think there'll be some pushback, probably. I think after $5 a gallon gasoline going back a year or two, people are very cautious about price, and I think auto workers want to make sure their jobs are there. But at the end of the day, I think this is a plus for the consumer, and it's a plus for the auto workers.
And something else I want to talk about, the Connecticut economy here. We know it did start off on a rather sluggish foot. It was relatively flat to start off the year. How has that changed now? And what sort of policies are you putting in place to boost the economy and really signal, especially to consumers who want to spend and people who want to come and work in Connecticut, that this is the place to be?
Connecticut economy is actually very strong. We have more private sector workers today than ever before in our history. We got 90,000 plus jobs that are unfilled at this point. It's a great time to be a young person. We'll provide you all the skills training you need, be it electric welder, or be it a nurse, or be it a teacher. We'll provide that. We can guarantee you a job at the end of the day, a job right here in Connecticut.
And you're going to have a lot of people wanting to flood and come down there. But in terms of where the need is, in terms of worker availability and worker shortages, where does Connecticut have the strongest need?
Certainly in manufacturing, as you maybe know, we make submarines and helicopters and jet engines, and there we're hiring many thousands every year to keep up with the demand. That's going to be strong demand for the foreseeable future. Greater New Haven areas are related to life sciences and biotech. I think a lot of demand there. And we have financial services and fintech from Hartford and down in Stamford, and there it's going to be AI and IT and those skills were really ramping up. So these are good paying modern jobs that are ready for you.
And in terms of how you're looking at some of these modernized jobs, I know Connecticut was also known as an insurance state as well, but you also have a lot of people looking for these innovative companies, looking for places to move, and also with some beneficial taxes as well. What is Connecticut doing to really bring that in?
We have probably 1,000 new startups a month going on right now. We used to be the startup capital. Remember Eli Whitney and Igor Sikorsky, the cotton gin and the helicopter. We got a little flat, but no longer. It's a very innovative economy. And that's what our marketing campaign is, reintroducing people to how modern and innovative our economy is. We call it Make It Here. It's a way to remind young people and those looking for a job, state-of-the-art innovative jobs are right here in Connecticut.
And something else that might lure people, you recently signed the largest income tax cut in Connecticut history into law this year, and you credit that with fiscal discipline in being able to make that move. But you're not supportive of higher taxes on the wealthy to really help boost the middle class there. Talk about that dichotomy there and how you were able to do this for the middle class and why you're not as eager when it comes to taxing the wealthiest Americans in the state.
Because we raised taxes a lot over the previous 20 years, and I wanted to be the first governor in the state not to raise taxes. We've had 5 balanced budgets in a row without raising taxes. We're living within our means, and that meant we've had some significant surpluses. That means I can provide a tax cut for everybody earning up to about $250,000. Makes us very competitive with the other states in our region and beyond. And it just sends a message. This is a good state to be in, a good state to start a business, good state to start a family.
And that's usually one of the reasons, people move to a state. You want good governance, you want the jobs, you want the infrastructure. Unfortunately, though, as we take a look at what's happening in the House and the governance there, the House Speaker fight that is ongoing, and especially as we're going to be coming into November, looking again at another potential government shutdown. What are your takeaways from how you're seeing this playing out at the moment and really the message that it sends?
I find those Republican congressmen a little flip when they talk about shutting down government. Talk to our governors, 50 governors, Republicans, Democrats, we can't shut down. You can't shut down corrections. You can't shut down state police. You can't shut down our schools. We can't shut down nurses and taking care of people with special needs. So we can't play these games. I like working with my fellow governors because we got to get the job done.
And do you notice a difference at the governor level in terms of the amount of, well, not so much bipartisan support, but how much progress you're able to make? And then when you sort of take a look at some of your colleagues in the House and really the clashes that they're continuing to have here?
We work together pretty collaboratively. When you have the infrastructure money, how you're putting it to work, what's the best way to build a bridge? I mean, these are not Republican Democratic issues. These are things that we share in common. We have common goals to get it done. And frankly, what's good for my state, Connecticut, I'm part of Massachusetts, Rhode Island, and New York as well. I want them to succeed because their success is our success. And we compare notes all the time. I find down in Washington, it's just the opposite. It's a dog-eat-dog game.
And our thanks to Rochelle Akufo for that interview. Everyone, we saw a mixed picture from Microsoft and Alphabet yesterday, but now investors are shifting focus to Meta. The tech giant is set to report earnings after the bell today, where analysts will be eyeing everything from ad revenue to AI. Yahoo Finance's Ali Garfinkel has the details. Hey, Ali.
Hi, Brad. Meta is coming into this earnings cycle on the surface on a bit of a roll. The stock's up more than 140% year to date, and that's despite some small declines today. And investors are going to be looking for updates in key areas that Meta has been prioritizing. Those two areas are advertising and AI. When it comes to advertising, Meta is going to specifically be talking about Reels. This is their short form video offering that has been launched recently that has been pretty impressive in terms of its penetration. $10 billion revenue run rate in the second quarter. Additionally, we saw some positive results from Snap the other day that read through really well to Meta. Now, on the AI front, Meta has been launching a number of features, both for advertisers and consumers. On the consumer side, they've really been focusing on generative AI and Gen Z. So there are some really good omens here. Now, there are also some asterisks. Particularly consider Reality Labs. Now, Reality Labs losses, we've talked about it a lot on this show, and it is something that investors have been feeling pretty dicey about. In 2022, Meta lost $13.7 billion on its XR and VR operation, and that number this year has gone to more than $20 billion. I'd add to that some concerns about Apple Vision Pro possibly being a competitor and some mounting legal concerns across the business. And you have some outstanding questions that Meta certainly has to answer for.
So what does the recent lawsuit as well, in terms of those questions that Meta has to answer for? There's a recent lawsuit from states. What does that mean for Meta and its bottom line moving forward from here?
Yes, Brad. So what happened is recently this week, 33 states and a total of 42 attorneys general have sued Meta, saying that their features that target children are actually proving to be addictive. This is something Meta disputes substantially. However, it's important to say I've been talking to a couple of sources here, and what they're saying is this is a long-term, multi-pronged approach. Don't expect this to be a flash in the pan. The ultimate goal is to get one of these cases to the Supreme Court. Now, this could find its way to Meta's bottom line over time, especially if this proves to be a prolonged legal fight. Consider that advertisers might want to step back a little bit from the platform because even though Meta disputes it, it's not an allegation that advertisers might necessarily feel comfortable with. Additionally, the company shares did take a bit of a hit as the lawsuit was announced. So it's something to keep an eye on moving forward.
Absolutely. Yahoo Finance's own Ali Garfinkel, as we're taking a look at shares of Meta over the past 2 days, down by about 3%, coming into this earnings report down by about 2.5% here. Ali, thanks so much for breaking that down here for us, and we'll be watching closely for more of these tech earnings as they continue to pour in. Let's do a final check of the markets here, taking a look at the major averages. You've got them in the bottom corner of your screen. They're mixed as of right now. The Dow seems like the lone gainer, and it is up fractionally right now by about 0.2%. The S&P 500, you're seeing that lower by about 0.9%. The Nasdaq Composite is down by about 1.7%. As I'm just taking a brief look at some of the sectors, staples leading the pack, that's up 0.7%. But we've also got communication services down by about 3.4% as more earnings pour in for some of those communication services companies here as well. We are seeing more laggards than advancers here, but of course none more in terms of the declines than communication services. And then just briefly, for those of you who've subscribed to at least one or two streaming services out there, let's just take a brief look at some of those streaming companies as Apple announced their pricing changes on the day. You're seeing shares down by about 0.9% here. Well, that does it for us here this morning on Yahoo Finance Live, but stay tuned later on today, 3 to 5 p.m. Julie Hyman and Josh Lipton got you covered from the New York Stock Exchange for Brad Smith, Shauna Smith, and the rest of our crew. See you tomorrow.